New York City, I'm Brian Sazzi alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Hey everyone, good morning. Stock futures are higher after the Fed's preferred inflation gauge came mostly in line with expectations. So let's get to it with the three things that you need to know to start your trading day. Yahoo Finance's Jennifer Schonberger, Jared Blickery, and Madison Mills have more.
A fresh reading on inflation today keeps the Federal Reserve on track to cut rates in September. On a headline basis, the July Personal Consumption Expenditures Index, or PCE, came in line with economists' expectations, both on a month-over-month and annual basis. On a core basis, stripping out those volatile food and energy prices, the monthly reading was as expected, while the annual reading came in just below expectations. The Fed expected to make its first interest rate cut of the cycle in September, traders pricing in a 69% chance of a 25 basis point rate cut and a 30% chance of a 50 basis point cut.
And Intel is weighing options to address its struggling business as shares tumbled more than 40% over the last year, while the S&P 500 has gained around 24%. Bloomberg reports Intel is working with Morgan Stanley and Goldman Sachs and is considering splitting its product design and manufacturing businesses and scrapping factory projects. Options include M&A and the possible sale of Intel's foundry division, which manufactures chips. Less than 5 years ago, Intel's market cap was more than triple what it is today. Discussions for strategic options are still in the early stages, according to the report.
And we're getting a look at the consumer this morning with some of those retail earnings throughout the week here. Lululemon missing on sales estimates for the second quarter and trimming its full year guidance. The stock, though, rising here in the pre-market trade as executives assuring Wall Street of its plans to fix any of those product issues. And beauty retailer Ulta falling as well after missing second quarter earnings estimates across the board and trimming full year guidance. Ulta CEO addressed the company's challenged market share as more competition is popping up during the earnings calls. Ulta and Lululemon executives also referencing cautious consumers and uncertainties around the coming months.
Consumer behavior is starting to shift as consumers increasingly focus on value and become more cautious with their spending.
We continue to acknowledge the uncertainties in the macro environment.
And that was just some of the commentary that you got on those earnings calls, guys.
Personal consumption expenditures, PCE, coming in line with expectations, rising 0.2% on a monthly basis, 2.5% year over year, showing inflation is still cooling. So what does this report even signal about the economy, and why does it matter for the Fed's policy rate? Yahoo Finance Fed correspondent Jennifer Schonberger has the details for us this morning. Hey, Jennifer.
Good Friday morning, Brad. That's right. This fresh new reading on inflation is keeping the Federal Reserve on track to cut rates come September. The Fed's preferred inflation gauge, as you mentioned, the so-called core personal consumption expenditures index, which excludes those volatile food and energy prices, clocked in at 2.6% for the month of July, a 0.1% better than estimates of 2.7%, and holding that same level as in June. This is particularly good news, given that the comparison year over year was tough as inflation markedly fell in the second half of last year, and this number still showed progress on top of that. Now, month over month, the measure held steady from June at 0.2%. At this point, Fed officials are feeling pretty confident that inflation is sustainably moving back towards their 2% target. They're now more focused on the job side of their mandate. They're worried about further weakening in the job market. Today's inflation report likely to cause the Fed to cut 25 basis points in June, not 50 basis points. For them to go 0.5% lower, we would need to see job market conditions deteriorate further. We will get another jobs report on September 6th. And guys, just anecdotally, speaking with Alan Blinder, former Fed chair and well-known economics professor from Princeton last week, he told me the job market can't cool much further without a recession. Back to you.
Oh, Jen, big fan of your big interviews with the Fed. Good stuff. Jen Schonberger, thanks so much. All right, for more on July's inflation print, we have Jose Torres, senior economist at Interactive Brokers, joining us now. Jose, good to see you here. I think throughout Yahoo Finance's programming, at least from 9 to 11 today, you'll hear a lot of economists say this is a Goldilocks economy. I'm not a fan of that term. Is it just an amazing economy because it's slowing but not too fast, and we're going to get more rate cuts and growth might pick up in the back half of the year?
Well, Brian, great to see you. I don't think it's an amazing economy, and the reason it's not phenomenal is because consumers and households alike are managing their budgets like light switches. Some months we're seeing significant consumer spending, while others, they're really hunkering down, looking to alleviate the budget from past spending and also looking to save a little bit and provide more space for further months. We saw that in June. June spending was weak, and July has been a huge expansion. As far as inflation has been a terrific story, Brian, and really has been all about goods and commodities cooling off. When you look at automobiles, they've declined in price every month this year. When you look at commodities, despite geopolitics geopolitical tensions beginning to mount, commodities prices are really well anchored. And those two dynamics have really brought price pressures lower. As far as services, it's been a little mixed, driven by the consumer spending ebbing and flowing sharply, but then also housing. Housing prices are at all-time highs, rents are still high, and those are still headwinds for inflation.
Jose, it's great to see you. As we were taking a look on the screen at the Fed's preferred inflation gauge, PCE, this morning, and really trying to get a sense of what this does, if anything, for what we've already heard from the Fed going into that September meeting that's going to take place in just about 3 weeks, the 17th and 18th here. We're watching the CME Fed Watch probability here, and it's just eased further towards this probability of a 25 basis point cut. So does this preferred inflation gauge do anything for September? For those who are looking for a 50 basis point cut and just kind of cooling those expectations? And then what is the signal for the rest of the year?
Well, I think as the Fed walks down the monetary policy stairs, it's going to be a slow walk, similar to what we're seeing in the ECB. They cut once, and now they don't know if they're going to reduce rates further. A serious consideration, alluding to what I spoke about earlier with the used cars, when rates start to come down, what's going to happen to pricing power at automobile dealerships? What's going to happen in the real estate sector? You have a lot of folks that want to get in, they want to buy homes. You have an underbuilt condition, substantial immigration flows. So as you begin to reduce rates, you have risks that the economy starts to overheat. Today's report also strongly supported 25 because look at the spending numbers, Brad. The spending numbers were terrific. Folks are out there, they're spending on services.
Jose, let me push back on that a little bit. I want you to take a listen to what Dollar General CEO Todd Vassos had to say about the consumer yesterday on his earnings call.
I found coming back is that our everyday low price was very competitive and continues to be even to today. So that gives us great confidence and a very good springboard to launch this promotional activity that we know exactly how to do and to be able to bridge the end of the month for our core customer because she's running out of money.
Jose, why are shoppers running out of money? With prices coming down, shouldn't shoppers have more money? And what's the risk to the economy when you have a low-income America running out of money the third week of every month?
No, there's significant risk. Overall, late cycle dynamics, particularly at the low end. Remember, Dollar General, Brian, tends to be a retailer for more lower and middle end households, and the consumer has been really bifurcated. You have those consumers that tend to be older, have more exposure to real estate, have more exposure to stocks. They're not doing particularly bad. The market has done terrific. But when you look at the consumer that's really focusing on labor income and is constrained by the pressures of higher prices, tall interest rates, reduced credit availability, and now job uncertainty, I think that's what explains the weakness there. Against the backdrop, Walmart has been gaining market share. That's something that we see also in late cycle dynamics. Back in 2008, we saw the same thing. Folks started to downgrade from spots like Nordstrom, Target, Best Buy, and go into Walmart instead.
Well, it's the trade-in to Walmart, as the CFO, John David Rainey, had told us here on Yahoo Finance, that they're seeing from the higher end of the income spectrum as well. So Is that alone enough to be a catalyst to propel Walmart to outperform against other retailers right now, especially if the high-income cohort right now is the one that's being relied on to offset what we're seeing in low-income cohorts?
Overall, I think that the shift towards Walmart just speaks to budget constraints being too heavy overall. Because remember, even higher income consumers, they're seeing some trouble too. They're nervous about stock market bumpiness. Folks are also worried about the election. We're going to get consumer sentiment in roughly an hour. Against that backdrop, there is general uncertainty as far as what's going to happen with rates. As rates slip, there's a chance that the job market does hang in there and that we don't see the unemployment rate start to accelerate. Because in the past, we've seen when joblessness starts to pick up, it really starts to ramp. And really the Econ 101 concept there, folks lose their jobs, they stop spending on other spots. Those spots now face revenue pressure. They have to release other folks. But since corporate balance sheets, Brad, are so strong this time around, we do have high odds of a soft landing. Maybe we don't fall into a slowdown and we can keep the expansion alive for a few more years.
Jose, what's your base case for GDP next year?
1.5%.
Is that why? To me, that's a slowdown from this year. I mean, is that the definition of a soft landing?
I think so, right? I think, as long as we don't go zero or go negative and we don't have any major credit issues, we don't have sharp job losses, as long as we can stay above water, I would consider that a soft landing. Remember, we can go down to 1.5, 1%, and then we can rebound, right? We can start, if inflation comes in closer to that 2%, then maybe the Fed can start to reduce and get closer to that 3% Fed funds and provide some kind of stimulation, going further. But right now, the main focus is, can the Fed reduce rates without reigniting inflationary pressures? We're seeing those problems in Europe. They cut once, inflation comes back up. We've seen these problems here in prior cycles. Whenever the Fed wants to deliver a dovish message, they want to help out the market a little bit, and then inflationary pressures reignite. Let's remember, early this year, the market was expecting 7 rate reductions.
Yeah, I mean, we were all anticipating that based on what economists, some of your industry colleagues were really calling for and expecting us to look for.
Hey, I wasn't. I was looking for no cuts.
No
cuts. No, I was looking for 7. Nope.
Okay. One more thing, real quick,
yeah.
Guys. The regional bank crisis in March 2023, remember, rates plunged. We thought we were getting cuts right around the corner, and they hiked after that, right? And then another important thing, gentlemen, is the Fed's balance sheet. They're going to keep reducing that even as they're bringing rates lower.
All right, we got to save that for our next conversation. Jose, great to see you. Thanks for joining us ahead of the opening bell this Friday. Jose Torres, who is the Interactive Brokers senior economist. Thanks so much, Jose.
Thanks for having me. See you next time.
See ya. Let's switch gears and talk Intel. Intel is reportedly weighing strategic options to address its struggling business. Bloomberg reports Intel is working with Morgan Stanley and Goldman Sachs and considering splitting up its product design and manufacturing businesses, plus scrapping factory projects. Shares are off more than 40% over the past year. The company reported second quarter results earlier this month that missed on sales, gross profit margin, and earnings, and then announced the suspension of its dividend. And, if that wasn't enough, they announced a 15% headcount reduction that amounts to about 15,000 people here. It sent the shares to their worst day or at least the share price action saw its worst day in about 50 years after that report.
Brad, this is a tough one. We should note, I did reach out to Intel for comment on this one, did not return my request for comment, but you could put a lot of pieces together here. Now, this is really after a couple weeks. Pat Gelsinger, CEO of Intel, came out here and announced 15,000 job cuts. This is a company that had been cutting jobs already. So I think that really shocked a lot of investors. Now, I asked Pat, what is going wrong with Intel? Because there were some signs of a turnaround a couple quarters ago. That does not appear to be the case anymore. Here's what Pat told us.
This is the biggest restructuring of Intel, I'd say, since the memory microprocessor decision 4 decades ago. We laid out the new operating model, and we're taking decisive steps to execute on the process and product work that we've done to now combine it with an operating model to make us effective for the long term.
So, Brad, this is, I would say, the most serious position Intel has been in for decades, dealing with a major transition. But when you hear them or this being floated, a potential sale or some form of transaction for the foundry business, Pat is the one that is focused on building that business up, really since he got in the house or back in the house here over at Intel. So to see a potential about face, whatever that might look like, is it would be tough to see. But this is a business under siege. Margins, sales. We've been talking all week about Nvidia. It is an Nvidia dominant market. Now Intel's going to have some new AI chips out later this year. But still, investors are obsessed with Nvidia, AMD, and Intel's not in these discussions.
I wouldn't be surprised if it made it into the discussions or even on the stage of debates later on in the presidential and general election cycle that we are in right now, because, oh yeah, a lot of people are probably going to think about that nearly $20 billion in U.S. grants and loans that Intel was able to take on to really boost a lot of that foundry business coming online. And so that's something that we could hear even more about from political candidates, all the while the business trying to figure out, all right, what is coming next and what are the cost-coming measures that they can continue to institute to offset some of the larger businesses' challenges that they're seeing right now.
Really good point there. All right, let's switch gears just a little bit. Let's talk retail, Brad. Earnings reports from Lululemon and Ulta both supporting the narrative that the consumer is a little more choosy. Of course, heard that over Dollar General in that earnings call yesterday. Lululemon lowering its guidance and posting its first revenue miss in almost 2 years. CEO Calvin McDonald acknowledging a slowing business here in the U.S. Despite all of that, though, shares are, well, you can see them up there on the pre-market. As for Ulta, a lot more bad news. Shares under pressure there a good bit after the company missing earnings estimates for the first time in 4 years and trimming its full-year guidance. Two wildly different stories. And Brett, I have to say, I'm surprised by that Lululemon reaction. Did not like that Lululemon earnings call last night. I do not like to hear when a retailer that is known for doing very good things or performing very consistently, essentially for the past six or 7 years, get on their earnings call and say, we're not driving enough product newness. We couldn't close the deal with consumers. Now, they are out here pitching that things will get better by the spring of next year, but I am concerned. Did not like their new long butt product, Brad. Do not like to hear people taking to TikTok saying they do not like their $150 pants because their butt is getting flat. So a lot of red flags for me. Lululemon has a lot of proving to do. They will likely stay in the penalty box today. I'd be a little concerned believing into this pop in the stock price here.
I mean, more squats, more kickbacks might help them out a little bit.
Long butt.
There.
Who the hell wants long butt? And these new pants apparently, and people were wondering, well, what is long butt? It's just flat. It's just flat pant. I mean, you spend almost $200 on a pair of pants. I want my cheeks highlighted here. I don't want long butt, Brad.
I don't want to think about.
Is that too much info? It's Friday.
Well, I mean, look, it is a Friday before holiday weekend.
We're streaming. We can do
they somehow still trust us with all the shows before holiday weekends.
Yeah, especially you and I. When we get in here on a Friday, it's not good.
Anyway, back to the numbers here. One of the huge things, and you were talking about the international opportunity here, and one huge word that is going to come up time and time again as we hear from companies like Lululemon, as we hear from companies like Nike, is newness. And we were discussing this yesterday with one analyst who was talking about this, and Jim Duffy over at Stifel.
Love that guy.
Yeah, and we were getting some great analysis on what newness actually looks like. You've heard all of these brands have to try and figure out how that's going to contribute to some of the growth targets that, for Lululemon, talking about quadrupling international revenue from the 2021 levels by the end of 2026. That momentum was strong in international, but by region, the results, China mainland, that was up by about 37% constant currency. The rest of the world was up by about 24%. And for a company that has really leaned into yoga for so many years, it's been trying to find different streams, different categories to get into. They got a partnership with DK Metcalf, who's on my fantasy team. Shout out to DK. Just drafted him yesterday. And then additionally, Odell Beckham Jr., who had his own spat with Nike. So all of that considered, we'll see if football plays out for them this season.
And quickly, I will add on Ulta, obviously, a new Warren Buffett favorite. Happy 94th birthday to Warren Buffett. I will just say, go read Brooke DePalma's story on Ulta's earnings. It's up on Yahoo Finance right now. I will add this key investor day coming up from Ulta in the middle of October. But this is another retailer likely in the penalty box. Margins under pressure, sales not going in the right direction, consumers under pressure overall. I think Ulta has a lot of proving to do at that October investor day to get the excitement back on the street, despite Warren Buffett really backing the company.
Yeah. All right. Well, I'm going to go try those long butt pants, I guess.
All right. No, please don't. All right. We're coming back at you with more analysis on all things stocks on this Friday morning. Stay tuned. You're watching Morning Brief.
Let's get to some trending tickers that we're watching on this Friday. Shares of Dell moving higher this morning. The company raising its revenue and profit forecasts, helped by demand for its AI-optimized servers, which are powered by Nvidia's chips. So a win for Dell, win for Nvidia, and ultimately here, they raised the annual earnings forecast as well, we should mention. Revenue in its infrastructure solution business is what they're citing here and pointing back to for investors.
Yeah, Dell has been, and I put this out on X this morning, one of the, I guess, really a secret or outperforming tech stock here over the past year. I mean, the stock's up over 300%, in large part because every quarter they come up here, Dell beats on earnings, has good things to say on the earnings call. I would argue has been out in front of many of its competitors on AI. And you hop on this earnings call, you hear the company talking about, in terms of backlog, looking at about, they've shipped $6.5 billion of AI infrastructure for its customers. They have a line of sight to almost $10 billion. So Dell is an AI play. It's not just some computing company putting stuff in boxes and shipping it out the door like they did 15, 20 years ago. I mean, this is an AI play, AI servers. It's a real thing. They're making real tangible things. And that's why I think you're seeing the stock up and another good quarter from Dell.
Good Austin, Texas-based company.
Indeed. All right, speaking of Nvidia, shares bouncing back today after yesterday's sell-off. Is the company looking for a new investment opportunity? Maybe. Nvidia and Apple are reportedly in talks to invest in OpenAI as a part of a new deal that would value the startup at $100 billion. Brett, how would a board meeting look for OpenAI? Microsoft, Apple, Nvidia. I mean, this is turning into a situation where I would argue $100 billion is not going to be the end game here. You have all these deep-pocketed tech companies potentially pouring money into OpenAI. Why not a $200 billion valuation? Why not a $300 billion valuation?
Well, I mean, look, you've got, as you're pointing out here, all your frenemies at one table potentially here, depending upon who gets access to the board, who gets seats, who is just a special advisor, and privy to the conversations that are taking place with OpenAI, which is absolutely revolutionizing, even at the consumer level, the thought process around generative AI via ChatGPT. And Microsoft was early to the game with this one. And so for OpenAI, we were talking about this yesterday, the potential for this round to really cement them as a $100 billion valuation in the private markets, which is a hectacorn. Move over unicorns and decacorns. You don't matter anymore. Hectacorns.
I never heard of that.
$100 billion. I mean, there's only 3 or 4 of them. This would be the 4th. I think that we ultimately have seen SpaceX be able to get into that lexicon. A few other companies, ByteDance is in that as well. Shein. Oh, I mean, my goodness. When's the last time you've heard of a fabric company as a, not fabric company, but a clothing retailer?
Who would you pick? If you had a choice between like 2 advisors on the board, I mean, Tim Cook or Satya Nadella, I'm going to have to go with Tim Cook. I'm feeling Tim Cook's vibes. I mean, he got us the Apple Watch, he got us the iPhone. Maybe Satya's like maybe more deeper into the AI
I think
stuff.
Satya actually.
Yeah.
I think they have more businesses that they have to be concerned about at Microsoft, and Satya might give them a little bit of a...
They do have LinkedIn. I love LinkedIn. Big LinkedIn fan.
LinkedIn, the growth at LinkedIn doesn't get talked about enough, actually.
No, it doesn't.
And that is an AI business as well, or it's starting to become one within the mask or the veil of a social networking professional.
Well, whenever, we were just talking about Dell, and real quickly, when I hear these valuations on OpenAI, I think it validates the moves you've seen in Dell, some of those second derivative type of AI infrastructure plays. I mean, OpenAI is doing real work, and some would argue it's scary work, but nonetheless, it's work that's happening, and it's really fundamentally changing how businesses get done.
All right, let's talk a little bit about Alibaba shares right now. Ticker symbol BABA. They are rising right now by about 4% here pre-market. The company completed a 3-year regulatory process following an antitrust fine that it received for monopolistic allegations here. Now, Alibaba has completed a 3-year process following that antitrust fine that it received for monopolistic practices in 2021. China's market regulator said on Friday here. You'll think back, and this really kind of cements more of the shift, at least, in sentiment that China has at this point, trying to drum up a little bit more consumer confidence in that region, but then additionally kind of easing on some of the crackdowns that they had previously implemented and put it into place. I mean, at one point, we were looking at a potential 6-way split up of Alibaba. No mas.
Yeah, I think our team just puts Alibaba anytime I decide to guest host because they know I don't really like talking about Alibaba, and I say the same thing. You can put my comments all together, and they're all going to be the same. As long as the China economy is under pressure, Alibaba is just not going to get it done. I mean, I would be concerned about the earnings reports, be concerned about the top line, be concerned about margins, cash flow, you name it, and then secondarily, what does this company do? I know they're an e-commerce play, but they operate other businesses. And until I think they can prove that out, that all those businesses still work.
Well, they tried to be Amazon.
They tried to be Amazon. And again, there's only one Amazon. All right, don't go anywhere. Stay tuned. You're watching Morning Brief on this Friday morning.
That is the opening bell on Wall Street. You've got Anne Juliet ringing the opening bell at the NYSE. And then you've got ER shares ringing the opening bell at the NASDAQ. They get some funfetti on this Friday here.
Where's Romeo?
I don't know.
You know I'm dropping that joke on a Friday.
I mean, look, he might have got pushed off the podium up there. Who knows?
He's probably an Nvidia shareholder. Tough week for him.
Yeah, well, anyway, taking a look at the NASDAQ, which has the Nvidia in it, as well as the S&P 500. They're not doing too bad here on the day. At least out of the gate, you're seeing the NASDAQ composite up by about 0.8%. Let's populate this chart for you, just give you a look at how things have been going over the course of this week. Some bad candlesticks that you saw on Thursday here. I made the mark, so I'll just circle that. Why not? And then additionally here, taking a look at the S&P 500, that out of the gate up by about 0.5%. Not a good 5-day look there that you've seen, though.
Do I have time to touch something? Well, I'm going to touch it anyway. Let's see if it goes. Volatility index. You know, we've talked really all week long about how volatility has fallen down the market from that really high in the earlier month. Really, with stocks really essentially crashed. Market calm is back, Brad.
Yeah,
market calm is back.
Good riddance
for now
to the early days of August when volatility did spike to levels that we hadn't seen since the onset of the pandemic. Some levels that we hadn't seen even since prior to that as well. Some of those new all-time highs actually that we saw in the VIX. And then additionally here, since you're hitting the 1-month chart, are you just hitting things?
No, it's fun. There's the peak. There's the peak. Early August, stocks really under pressure, and things have calmed back down on Wall Street. Kind of digging it.
There we go. All right. Well, for more on today's trading activity out of the gate here, let's get on over to Yahoo Finance's Jared Bilkery, who's standing by at what we call the big. I tried to call it the Jumbotron. I've been voted down, Jared. I'm sorry.
Yeah, I like the big. And I love a VIX analysis on a Friday morning here, especially as we head into a Labor Day weekend. I think this was a pretty good week overall. You're going to see the major indices. They were in the red for the most part, but it could have been a lot worse considering that there's basically no volume and liquidity in the market right now. I'm showing the S&P 500 equal weight because that is an index that hit a record high only yesterday. And one of the themes I've been tracking here is we have a lot of markets that are just kind of breaking out or on the cusp of breaking out. And we can go across the board here, and I'll get to some sector action in a bit. Real quick, just want to show you the US dollar heading up again, so that's a potential headwind for risk markets that we want to keep an eye on, but not any red warning flags just yet. Now here's the sector action. Tech is leading today, so is consumer discretionary. Both of those outperforming. Energy trading to the downside. But let me show you what's happened for the week here. Financials, industrials, materials, those are the three leaders. And a lot of these sectors, including financials and industrials, have been hitting record highs recently. And so I said some of these markets are breaking out and also consolidating to break out. This is the former. This has broken out to the upside. That's XLF. And here's XLB. This is just barely breaking out. And I was actually trying to hit XLI, the industrial sector. That is breaking out as well. But a couple of markets I have my eye on that are about to break out. One is biotech, and let me show you a 5-year chart so you can see what I'm talking about. This hasn't quite cleared an important resistance level. 150 is in there, but it's trying to get there. And if it were to cross that threshold, probably heading to record highs and potentially there beyond. Also want to track the iShares US Aerospace and Defense ETF, and this is something you can see, it's been a while in the making, but this has really accelerated to the upside. I'll dial this down to a year-to-date chart so you can see that. Finally, I just want to close on the retail sector, and let's see if I can find XRT there, down 2% today, but this is a year-to-date chart, and what strikes me is that this is just a lot of sideways action in here, and so this is not in that list of about to break out or breaking out. Guys?
Jared Bickery, thanks so much. Appreciate it. All right, it's time for today's strategy session. Let's dissect the numbers from your favorite local retailers, Lululemon, Gap, and Ulta. Joining us now is Dana Telsey, CEO and Chief Research Officer at the Telsey Advisory Group. Dana, always great to get some time with you. Appreciate it. This has really been a mixed earnings season. You have a Dollar General warning about consumers running out of money. You have some of the department stores doing, I guess, maybe a little bit better. I mean, overall, what has been your takeaway from retail? What are you telling clients here?
I think overall, and first of all, thank you for having me. What I'm seeing out there is a definitely more discerning, intentional consumer spending shopper. They're intentional in their spending. We've seen all levels of income and household incomes trade down. The focus on value and innovation is what matters. There definitely have been the haves and the have-nots. You look at the off-pricers with TJ and Ross having 4% comps, Burlington yesterday with a 5% comp. You look at value with the Walmarts and Targets, and then you look at innovation. I mean, the double-digit gains at Birkenstock, at Abercrombie and Fitch are impressive. And yet you have some of the have-nots. The department stores in that area. We've had certainly some of the specialty apparel retailers being in that area. But newness and innovation matter, and you couldn't hear it more than what you heard last night. You had Lulu, Ulta, and Gap. It was impressive to see that Athleta's could return to positive comps. Lulu, the headwinds on the women's business, and that newness in terms of seasonal colors and styles, prints and patterns, that there'll be a runway till that gets back to historical levels is in focus. And you take a look at Ulta, which lowered expectations, and the increase in competitive distribution points is creating a headwind. So there, it's not one path, it's multiple paths, but it's the haves and the have-nots that I'm seeing out there.
You know, it's so interesting, and I want to come to that point of newness. I brought that up earlier in the show as well when we were discussing Lululemon specifically, especially considering the broader environment that they find themselves in of athleisure. My question to you is, what happens when newness doesn't work? When you have customers coming back and saying, hey, I don't like these pants I bought, they make my butt look flat, stuff like that, and all that effort that went into R&D is now just taken off shelves?
Well, keep in mind that that's the breeze-through pant for Lulu that basically was a negligible part of the offering. They're going to retool that fabric and make it with fits, hopefully, that are more compelling. Not every item that companies introduce is going to be a winner. And we've seen that over and over again. The speed to market, the agility, the ability to chase are all what's different today than what it was 10 years ago. And brands need to reinvent themselves. If you don't reinvent, you're going to go to the bottom of the roller coaster instead of the top. What we have today that's different in the past, look at the loyalty members, whether it's at Lulu, whether it's at Ulta, whether it's at Bath & Body Works, the data from these loyalty members informs you on how to capture that customer.
Dana, I caught up with Gap CEO Richard Dixon a couple days ago. I remember from his time at Mattel, and I really came away impressed on how deep he's digging to structurally fix Gap, the Gap brand, Old Navy, Athleta, and of course Banana Republic. As you look into the back half of the year, is Gap going to be one of those surprise winners for the holidays as he also lights up some of his marketing campaigns?
So marketing is a spending uptick, and you're definitely seeing that the innovation and the collaborations that they've put into the brands are resonating. It's becoming more modern. Take a look at the comparisons, though. You have really tough gross margin comparisons in the fourth quarter. You have 5 fewer days between Thanksgiving and Christmas. So you may get an uptick in sales. Are you going to get any leverage on it? Will be the question going forward. And that's for everyone. Obviously, you have 5 fewer days. And today, what you have different than would have been expected 6 months ago, increased freight costs.
Dana, while we have you, it's interesting because we're, at least within the skincare or the little luxuries part of the retail environment, we're seeing like one of these things is not like the other type of play out. And I bring that up as we're looking at Ulta's results here. And I kind of think back to what we had heard from Bluemercury within Macy's, where that company was talking about what they had seen in achieving their 14th consecutive quarter of comp store sales growth, 2% gain, net sales growing 1.7%. What's happening with Ulta that's different from what's taking place at Macy's and Bluemercury?
I think you have a couple different things. I think you have a wider customer base at Ulta than what you have at Bluemercury and what you have at Sephora, meaning it is one of the only ones that caters to mass and also prestige at the same time. I think Ulta had been open earlier, perhaps than a Sephora after the pandemic, so their comparisons become more difficult. And that's one of the changes because some of the city store locations didn't open at the same time as suburban locations did that are off mall. And then I think you had the ERP systems implementation that was disruptive that's going to be settled out. I think you obviously still have a significant market share at Ulta. It's retooling in order to be able to navigate back to more significant growth. October 16th, they're going to have an investor day. It'll be interesting to see the algorithm that they put out there for the long term.
Dan, just staying on Ulta, what do you think a Warren Buffett, I mean, who knows what anybody is essentially thinking, but what would a Warren Buffett be seeing? Let's assume that he's looking out and he plans to hold Ulta for 5 years. You know, where is this chain and company 5 years from now?
I think what he's looking at and seeing is it has a widespread consumer, both mass and high end. I think you have an ability for more stores to open. You have a smaller footprint of 5,000 square feet boxes that they've been testing that they haven't said what the potential could look like. You take a look at what they just did with Mexico. So is there international opportunity? The Ulta Beauty private label collection, which typically accounts for 3 to 4% of sales, was just relaunched. And the opportunity to have services inside the store drives attachment sales and garners a repeat customer. And you have a stock that has come down already, taking into account what was expected for reduced guidance. What the path forward is that's the opportunity.
Dana Telsey of the Telsey Advisory Group. Excellent insights as always, Dana. Thanks so much for joining us here this morning.
Thank you for having me.
Certainly. Hey everyone, coming up, Nvidia is paring losses after its Q3 guidance underwhelmed investors. We'll break down the biggest AI plays next.
August has been a volatile month for markets. It came in with a shock rout on Wall Street, but is poised to go out with some, well, feel-good vibes. The S&P 500 and the Dow are poised to add to gains for the month, while the tech-heavy NASDAQ is looking at losses. Now, looking ahead to September, well, it might get even worse for the sector. Historically speaking, September has been the worst month of the year for the U.S. stock market. Going back to 1928, the S&P 500 has been down slightly in September. That includes presidential election years. So here's my big chart for the Yahoo Finance community that you must watch, and it's a really simple one, so simple. Nvidia versus the S&P 500. Nvidia makes up over 6% of the S&P 500, and if pressure on Nvidia continues after its earnings report this week, it could spark fear in the broader S&P 500, and that is better known as more selling. Brad, that's going to be a tough one to follow.
All right, well, let's hope for a September that's different from September's past, but history is the guide. There hasn't been a lot of fanfare for September historically. Thanks, Saz. Nvidia shares are paring losses after its third quarter guidance underwhelmed investors. Traders questioning whether or not Nvidia can keep outperforming its past growth. Here with more and his take, we've got Richard Windsor, who's the founder of Radio Free Mobile. Richard, great to have you here on the show with us. I want to get your read through from what we saw from Nvidia earnings here, and how difficult is it going to be for them to sustain the growth at the rates that we've seen and become accustomed to at this juncture?
Okay. Sustaining growth at the current rate, impossible. This is probably this year, $130 billion business. It's virtually impossible for them to grow it again at like 135% or so. And consensus clearly points to that. Consensus is looking for about 40% revenue growth next year. And that's really where the problem lies. Certainly in terms of expectations and outlook, because the company admits things are going to slow significantly next year. And if you take them at their word, you would probably go 20 to 40% growth, somewhere like that, and 40% is already baked into expectations. So that's where the level of disappointment lies. However, it's not all bad news, because if you look at the financial performance of this company, it is a shareholder's dream, i.e. almost all the profits and all the cash flow flows straight to the bottom line, which is why the company is only on 30 times forward earnings, which in the tech sector is not an outrageous multiple. And that's why it hasn't fallen 20 to 30% yesterday and continued to fall today. It's got strong valuation support.
Richard, if someone has owned Nvidia for the past 5 years, they're sitting on big gains, and they see a quarter like this, what should they be doing next?
Excellent question. If we break down exactly what there is and what there is not. So the stock's gone up 10 times in the last 18 months. Is it going to go up 10 times again? No. What that tells you is that the easy money in Nvidia has been made. So if you're the type of investor that likes to pick winners, go for alpha rather than a beta return, arguably perhaps you should sell it and buy something else. Flip side of that is, if you are a beta type of investor, then, and look at it relative to the rest of the technology sector, 30 times earnings and 40% and probably more than 40% EPS growth next year is a much better deal than you will get in either Apple or Google or Meta Platforms or Amazon. So from a valuation perspective, you could make an argument to hold on to it. It's really down to the type of investment style that the investor is choosing that would make that decision.
Richard, it's interesting. I've been kind of nerding out this morning on why Nvidia has really the entrenchment that it does. And it comes back to what's called CUDA as well here, Compute Unified Device Architecture, and its chips being the only chips that could really run this for a certain point of time. And now it seems like there's going to be, some ability for that to run on other chips, or at least a means by which that could be done without sacrificing compute power. And I bring that up because investors are trying to figure out as well where there are other companies that they could look at, chip companies that could have a similar type of output without the energy constraints, if you will, for the data center. All that considered, what are those other companies that investors would be apt to look towards?
Well, it's going to be the usual suspects, isn't it? So if you look at Meta, Microsoft, Amazon, they're all and Google, they're all designing their own chips. There's plenty of competition out there. There's a company called Cerebras, which is private, another company called GraphCore that's just been acquired by SoftBank. There's plenty of competition. The real problem is, I suspect that in this generation, and while CUDA remains so important to developers of artificial intelligence, no one is going to lay a glove or even make a dent in Nvidia's market share. Now, that's not going to continue forever, but I think for the next 18 months at least, that's the way it's going to be.
Richard, do you view Tesla as an AI play?
No. And the reason I don't view Tesla as an AI play is that it predominantly makes money out of selling boxes of metal. Admittedly, they are quite good boxes of metal, and the electronics and the user experience in them is quite good. But I wouldn't view it as an AI company for two reasons. One, I think Tesla's philosophical approach to how you solve the AI problems is not right. And secondly, the business model that the company is proposing for robo-taxis is so fundamentally flawed that the shares are probably even now still substantially overvalued.
Do you think that we're in the midst of an AI bubble bursting after Nvidia earnings, and ultimately we saw Nvidia move lower the day after its earnings? The rest of the market kind of still was able to hover, but I mean, AI as a theme that we've continued to hear over earnings calls, that could need some fresh wind from elsewhere, and the question's in the air of where that comes from at this juncture.
No, I don't think we're seeing the bubble bursting. We may be starting to see the beginnings of the wobbles or the concerns that cause it to burst. What I'm expecting to cause it to burst is falling valuations in private markets. That will imply is that private companies like OpenAI and so on and so forth are failing to meet their expectations and are being forced by VCs to accept lower valuations when they next raise money. That's what triggered the popping of the autonomous driving bubble, and I suspect this one is going to be the same. We haven't seen it yet, although people are starting to ask some of the more difficult questions.
Really liked how you framed a Tesla. Yes, metal boxes with some rubber wheels on them. Richard Windsor, founder of Radio Free Mobile. Good to see you. Have a great weekend.
Pleasure. Anytime.
All right, much more markets analysis coming straight up on Yahoo Finance's Morning Brief. Time now for our Stocks in 30. I'm taking a look at MongoDB, out with earnings that showed strong revenue growth and surpassed estimates. Brad, I originally thought maybe this was the company that made the material for the Lululemon long butt pants, but I'm really not. That is not the case. They're a tech play, and I do not like what this company had to say. I don't like that margins were down year over year. I don't like that operating profits were down year over year, and that's really all I have to say on MongoDB.
All right, well, share right now, as we were taking a look at it on the screen, if we could toss that back up. As of right now, we were taking a look at MongoDB shares, and the stock right now holding on to gains of 17%, regardless of how much you might not like this.
No, I have no problem with MongoDB, but they're just a tech play. I'm not too sure people are familiar with what they do.
Yeah.
They do tech and AI things.
People who know what MongoDB does are the people that need to know
That's correct.
what it does.
I mean,
Stock's down 25% year to date. Also, I'm watching shares of Autodesk. Autodesk, on the company's results here, they raised their full-year earnings outlook following pressure on the software maker from activist investors Starboard. And taking a look at the shares right now, they're up by about 4.4%. Interesting on the earnings call as well. I mean, this is a business, and I remember using some of these platforms when I was in high school and wanted to be, I was an aspiring architect, and Autodesk has been around for a while. So all of these things considering, AI can have a large role going forward here. They've made some large investments in cloud platform, AI in the pursuit of some of those growth opportunities. They talked about that on the call.
you still are an architect, Brad. Every day you build this show. You build the narrative for global investors.
With our team of contractors that we have in the newsroom, yes.
Oh, Brad.
Our producers, we are all building this together.
Plus, all right, Netflix getting a street high price target of $900 over at Pivotal Research. Really good note. Pivotal does good work. Really enjoy their notes and their research. But a very simple thesis here for all things Netflix. They are the dominant streaming platform in the world. They have taken on a lot of competition, but still they're growing subscribers. They're pushing through price increases. They're growing more overseas than they ever have before. You put all that together, you get a $900 street high price target on Netflix by the folks over at Pivotal.
All right.
There we go. Coming up, we're getting a fresh read on the consumer with University of Michigan's consumer sentiment data out at the top of the 10 a.m. hour. We'll give you the latest, or really the best and the latest analysis on that one and all things stocks.
There is far more to talk about on Netflix here. I mean, it's just Stocks in 30, so
Yeah.
it couldn't.
Yeah. Okay. Catalyst coming up.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Catalyst, everyone. I'm Brad Smith alongside Brian Sazi. We are about 30 minutes into today's trading activity, and we're watching three catalysts here today: the state of the consumer, the tech trade, and Vice President Harris's first interview.
August consumer sentiment showing the U.S. consumer is cracking as prices continue to put pressure on their wallets, and the pain is trickling down to retail earnings. We'll discuss what this means for markets and the broader economy.
And is the AI trade hot or not? What a game. Executives for big tech firms are still excited about the potential for AI growth, while some experts seem to be growing a little bit more skeptical, especially off the back of a somewhat disappointing outlook, at least from Nvidia.
All right, plus Vice President Kamala Harris finally sat down with the press for an in-depth interview for the first time since launching her presidential campaign. We'll dive into what investors need to know about her policy changes later on in the hour. But first, we have breaking consumer sentiment data, 67.9, less than what economists were expecting for consumer sentiment, Brad. And I can't say I'm surprised. We've been talking all morning long about those Dollar General results and that earnings call where the CEO gets on there. Todd Vasso says people are running out of money by the end of the month. I mean, not every consumer is feeling good, and not every consumer is in the capability or have the capabilities to go out there and spend willy-nilly.
Yeah, one of the huge things that we're kind of able to take away from this report, at least in some of the commentary that we got from the Survey of Consumers Director Joanne Shu, who said sentiment this month reflects a slight rise in sentiment among independents. And this is even more interesting because this has continued to look across where, as we get towards the general election, how consumers are even navigating some of the larger events, and really pointing towards November here at this juncture. But these patterns resulted in what they've seen from a sea change in election expectations this month. Harris emerging as the Democratic candidate for president in July. You'll remember 51% of consumers expected Trump to win the election versus 37% for Biden, and election expectations have flipped. Why do I bring this all up? Because this is playing into the consumer mindset, at least according to the University of Michigan here. 54% expecting Harris to win, so economic and election expectations both subject to change as election day approaches, but that one of the larger or more outsized portions, or at least catalysts within the consumer mindset in this report reading.
Right on. Stocks rising a little bit as they're poised to end the month of August higher after a very rocky start. Heading into September, stocks don't tend to perform as sweetly as our pumpkin spice lattes to kick off the fall season, and most of the market strategists we've talked to agree. Here's what they told us.
I think we're going to see the market continue to churn below the July 16th high. So I think that the churn will probably continue through September, October, until the November elections.
I am expecting volatility to pick back up again back in the fall months around September and October.
You also tend to see, 1, 2, or 3 other corrections by the end of the year. So I think we'll likely have another corrective period.
So could rate cuts be the catalyst to help the rally avoid the September effect? We have Olalu Oganga. She is the U.S. Chief Investment Officer at Mercer. Good to see you here this morning. You just heard Brad and I talking a little bit about the state of the consumer. Does the consumer have an out? Like, when do things get better?
As we start looking at just even the events of this year, so finally we had the Jackson Hole speech, right? It's time for policy to adjust. It's really indicated that the odds are there will be a September rate cut. It's about time. Now, if you think of the Goldilocks moment, so it's not quite too hot, not quite too cold, it's trying to bring it down. We expect rate cuts to happen 25 basis points each of the next few meetings in a more gradual format. Now, yes, there is some pain with the consumer, but this is expected. The goal was to slow things down a bit and bring inflation lower, and we're starting to see that. So it's not unexpected.
It's a consumer that's navigating so many different events right now, and as of right now, within this University of Michigan survey here, consumers' short and long-run economic outlook both improved here. Yeah. But as you're kind of looking out to the rest of the events that the consumer is going to have to navigate, elections has been one of them. That played out in this report as well here. Yep. What is the catalyst for consumers to make them feel more comfortable than they are right now?
So at the end of the day, we have policymakers in place that are stabilizing the overall economy and the markets. There are three main things. So if you start, again, as I mentioned, the Fed, they're monitoring rates. That feeds into mortgage rates, lending rates, the average things that you see. They had to bring it down from a consumer standpoint. That's number one. Then the next thing, if you think from a consumer standpoint, and just the overall economy, is all the volatility and maybe geopolitics that could be slightly destabilizing, either from a macro standpoint or elections. Now, elections could be nerve-wracking because it brings uncertainty, but at the end of the day, with the three branches of government, you need all types of alignment, so many things need to happen there.
We had another economist on in the other hour, and their base case for GDP next year was 1.5%. That really took me by surprise, because if we're getting rate cuts, shouldn't the economy be growing faster than that?
So we are in a situation whereby the economy has been strong. That, that's a little bit of an outlier type view, and you're surprised, we're surprised. For us, we view this as a very moderated process to occur. I would be surprised if you saw any big gaps. Right now, even Jerome Powell indicated strength across a number of areas, but did actually talk a little bit more about the unemployment and labor picture. So that was a focus. Unless that falls apart or it becomes a little bit more acute, our view is more measured than that.
What are the sectors right now that investors can feel comfortable dipping their toes in or adding on to their positions, even knowing what the consumer strength is looking like, especially across cohorts that are feeling the pressure a little bit more and those that are trading into lower priced options as well?
So at Mercer overall, we look more from a broader asset allocation standpoint rather than sectors. However, even if you were to look at some of the bigger themes, we know the direction of rates is lower. Mm-hmm. This summer alone, you saw the sectors that did pretty well were those that were linked to rates. So REITs we saw, financials we saw, clearly healthcare has something more to do with potential elections and some of those focuses. But I would say where you're seeing bigger moves, so what would benefit from a rates lower type of environment. And then the other areas are some of the bigger things with regards to policy, so infrastructure and where you're seeing political dollars go into.
Is this a market that is just too obsessed with every move or comment on Nvidia?
Yes.
I mean, there's a bunch of other stocks out there.
You didn't even finish it.
Right? Do you get people, there's other things to buy, right?
I started my career, over 20 years ago, and I was on a trading desk, and it was minute by minute, right? Like minute by minute, that's all you think about. And then you realize that if you you start on Monday, minute by minute, you go on Friday, just do nothing, you've circled right back, right? That's what happens. So we typically say, just pause. Just like the volatility we saw 3 weeks ago, when there was a big drawdown, dissipate in a few days.
Can the market work higher if Nvidia is not working and going up into the right?
Right now we're saying Nvidia. Last year it was 7 stocks, right? So it's moved from the magnificent 7 headlines all the time to the 6, right? And now it's just the one. We'll change out the name pretty soon.
As we're looking for a changing of the name and looking for whatever the thesis or whatever the major theme is that prevails next, how do you best anticipate the theme if we're moving from AI into the next major thing that companies are going to talk about? I mean, 1 year it's NFTs, 1 year it's blockchain, this year it's generative AI, and that being the next kind of iPhone moment. How do you best anticipate something like that if you're an investor?
So, and that's where we spend a good amount of our time. So what are the long-term trends and themes? Now, technology as a big block has been a very, very big driver, 10, 15 years, right? And as a result, pushed up growth stocks. Within technology, it's where people are spending money. Where's the CapEx? Right now, it's AI and generative AI, and that popped, maybe start of the year, last year, right? It was a big focus. But we tend to look at where the investment dollars are going. So for the companies themselves, within equities, what are they developing? Tech right now is where there's been a lot of spend, and it's been, varying within that.
Brad, well, I actually started buying Starbucks shares when I started drinking coffee at 10.
Really?
No, I'm just kidding. Absolutely not. I don't own Starbucks shares.
You
Did not do that.
drinking coffee well before 10 o'clock.
Do that.
You started at 10 p.m. the night before.
Yes,
what I believe.
no comment.
Olaolu Oganga, who is the Mercer U.S. Chief Investment Officer. Great to have you here with us.
Thank you for having me.
Good to see you. Absolutely. Well, let's stick with AI. Nvidia closed out a pretty mixed quarter for tech company earnings with a stumble as investors become wary of promises around AI growth. Now, the analysts we spoke to around Nvidia's results saying they could see some weakness from here. Take a listen.
At 6% of the index. Tech has become 31% of the index, and with communication services, 40% of the index. It's more top weighted than it was in 1999. It's not going to hold.
What it's not that good of a news for is the rest of the technology complex. AI has taken the oxygen out of the room for a lot of software companies.
We are in a lull, if you will, in the product cycle, completely expected, but a lull. And we do believe we will see Nvidia trade lower.
But still, the executives of these big tech firms, they remain optimistic.
Overall, AI PCs, we said before that we expected them to be 10% of the market in the second half, and we think we are going to be above that goal.
Hopper demand remains strong, and the anticipation for Blackwell is incredible.
So you're going to be able to do all these things right inside our platform, and that is exciting for our customers. They get real value from AI now.
So the bottom line here, Sazi, I mean, we're getting a mixed picture of where AI hype is headed, and that is the larger concern around any type of bursting that we might see in the future of an AI thematic bubble.
I often very much agree with you a lot of time, most of the time, but I have to disagree a little bit, Brad.
Go for it.
I think AI is just doing fine.
It's here to stay.
When I hop into a Dell earnings call and I hear the word things like accelerating AI server demand, you cut through all the hype and pomp and circumstance around NVIDIA's earnings. You hop onto their earnings call. I hear the word accelerating demand for AI. I hear a strong backlog of demand for their next Blackwell chip. You saw a clip there from Salesforce CEO Mark Benioff. He's getting ready to drop a whole bunch of new AI software at Dreamforce in a couple of weeks called Agentforce. I mean, the amount of AI that is about to come onto a Salesforce platform is very, very significant. Even HP, you saw a clip there with CEO Enrique Lores when we talked. I mean, he is looking at how to deploy various AI levels or various AI applications inside of his own company to drive more efficiency. So this is not just a one-day trend. This is something with us. It's accelerating, and a lot of companies are going to make a lot of money for a long, long period of time.
Well, I don't think it's a one-day trend at all, but I do think that you're going to have companies similar to those who were trying to figure out how they create a smartphone, figure out that, okay, their investments towards doing that did not work. There are going to be companies who have said and had a lot of talk about generative AI, but it has nothing to do with their business.
True.
And so they're the ones who investors are going to hold to task. They're the ones whose stock prices and the share price valuations are going to pull back, and those who it's actually real for, whether it be the applications that sit on top of the language learning models and the companies that bring those to life and maybe even open source them, and then those language learning models that sit on top of the chips. It's going to be those in that stock or in that stack that are actually going to see their growth into those valuations, lofty as they may be and forward-looking as they may be, that's going to be more sustained than a company that's just going out and say, hey, yeah, we're going to AI your peanut butter and jelly sandwich, because that's not going to happen.
Hey, if I hear Waste Management get on their earnings call and say, hey, we're creating AI-powered trash bags or trash compactors, I mean, that's just a red flag to me. Get out of NVIDIA and go find another stock.
Well, they're going to make it seem logical for the investors out there, right? They're going to sugarcoat it and say, hey, yeah, we're going to have AI in the trash trucks themselves.
I'm bullish on AI-powered trash just machines. I mean, they can pick up our trash quicker, get it out the door. I mean, I Waste Management, if you're watching this, and I'm sure you are, I mean, just go get these things to market.
What
please.
happens when it runs over your trash can?
Well,
Still
hey,
happy?
look. Sometimes I just have no answers, and that's one of them. So.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance and Catalysts.
The crypto market taking a few hits this week, with the largest cryptocurrency, Bitcoin, falling below the benchmark $60,000 level as investors sell out of risky assets. Brad, I know you've been watching this fall or pullback in Bitcoin. Interesting to see. And of course it comes, and I say it's interesting because it comes at a time where the market is really rallied back from the pressure it saw earlier this month.
You know, it's also interesting in what we've seen in some of the largest holders or hodlers of crypto, because they're going to be tracking some of these pullbacks to do a little bit more dollar cost averaging as well along the way and hoping for that ride back up. And for companies that you're tracking like a MicroStrategy, that might be paying off. We were actually just discussing this yesterday as well and trying to figure out, okay, if you continue to see Michael Saylor sell at some of these high levels and then wait for that pullback to buy back in, then you're looking at successful dollar cost averaging and being able to house some of those profits as well along the way. But it's really more determinant among the longer trend here. And so what are some of the catalysts going forward here for Bitcoin and Ethereum or cryptocurrency as a whole? It's making sure that it stays within the lexicon of Capitol Hill, quite frankly, and some of the other central banks around the world, especially given the election year that we are in more broadly around the world, where you're seeing more than half of people engage in elections, more than half of the world's population, I should say, engage in elections in one form or another. Cybersecurity, well, cryptocurrency, excuse me, certainly on the ballot, or at least in the conversations leading up to those elections.
Yeah, also add, it's interesting as well to see this because this is a very risky asset, obviously Bitcoin, Ethereum, you name it. And normally risky assets tend to be, just pick up or appreciate in value when you get a prospect of a rate cut.
Yeah.
So it's just, I don't know, befuddles me a little bit.
Yeah. We're also watching shares of cybersecurity company CrowdStrike on the rise today following an upgrade from hold to buy from HSBC to $339 a share. Now, this is despite cutting guidance for full-year earnings on Wednesday, and the company's saying that it plans to issue $60 million in credits to companies if they remain with them after July's massive outage, which caused widespread disruptions. Take a look at shares here today. They're up by about 3.5%. But I mean, take a look at the longer chart for this company, ticker symbol CRWD here. And you'll ultimately see one that has been embattled as of the midpoint of this year. Just taking a look at the last kind of 2 months performance and seeing that major dip that we had seen post-outage here. But year-to-date, still holding on to gains of about 13.5% right now.
The team over at JP Morgan, Brad, out with a note on CrowdStrike, and I think this sets a tone for what I'm about to say. JP Morgan noting the company was executing very well before the outage with better than expected execution afterward. And I think this is a market that wants to immediately think that CrowdStrike is going to go back to when it was executing flawlessly. The stock was ripping higher every single day. Earnings reports were robust. And I will just caution everyone, this was a major event that cost a lot of companies serious money. As you know, Delta, a company that you talk to, Ed Bastian all the time, Brad. Yeah. And I think it's going to take a long time to rebuild customer trust, and then by extension, start to rebuild that sales and earnings base.
Yeah, two words are going to haunt them as of right now, at least in the near term, and it is deal scrutiny. Mm-hmm. More of those deals that CrowdStrike is trying to bring forward are making their way up to levels that typically would not have to be sought out. And what I'm saying is what they talked about in the earnings call. They're seeing more of their deals have to go and get approval by the CEO of a company, whereas before, it might have just been the chief technology officer of a company or the chief information security officer of a company. Some of these deals even going up to the board of directors of companies. So now you've got 6 to 12 people who you have to appease and appeal to as well. So that just means elongated deal cycles. That means more deal scrutiny and really trying to figure out where this company can solve the issues and make sure that it is the right solution for them. But good execution up until that point, and we'll see how they recover from
What do they say, Brad? A lifetime to build a reputation, and it could end in a second? Or I'm paraphrasing there, but I mean, that's essentially CrowdStrike in a nutshell.
That's the essence of it. Guys, coming up, Vice President Harris gave her first sit-down interview as the Democratic nominee last night. We'll break down what she had to say after the break. Vice President Harris and Minnesota Governor Walz on prime time Thursday evening with CNN's Dana Bash for the first TV interview as the official 2024 Democratic nominees. They discussed a number of economic issues from housing to the child tax credit to fracking. Yahoo Finance's Rick Newman joins us now to break it down for us. Rick, what were your biggest takeaways here?
So much drama, guys. Kamala Harris, the first interview. Dun, dun, dun. Okay, well, we got the first interview out of the way. I think she maybe got a B or a B minus. She didn't do anything damaging to her campaign. I don't think she lit the airwaves on fire either. She was very guarded when she answered questions about why she's changed her positions on things such as a ban on fracking, which she used to support, but she no longer supports. Some of the other things she said she was for when she ran for president the first time in 2020 that she's no longer for. So we got that out of the way, and I guess now we move on to the debate that's coming up next week between her and Donald Trump.
Rick, do you get the sense that this is a Kamala Harris, a Vice President Harris, that's trying to have the appeal of a more business-friendly or one that is at least more amenable to extending or expanding relationship that may not have been there before with the business community?
I think it's a little bit more geared toward getting moderate votes that she probably would not have gotten had she become the Democratic presidential candidate in 2020. So just to go back to the fracking ban, fracking, the new technique for drilling for oil and gas is pretty important in Pennsylvania, in southwest Pennsylvania in particular, where there's a huge shale formation. And there are something like 25,000, 30,000 jobs in the oil and gas industry in Pennsylvania. And she has to win Pennsylvania to win the White House, basically. And it's super close. So I think she's thinking really hard about how to make sure, at the minimum, she doesn't turn off those voters in Pennsylvania, and maybe it gets a few of them. So, yes, I mean, the bank shot here is, yes, it does sound friendlier, certainly to the fossil fuel industry. She's not talking about attacking the fossil fuel industry. I mean, she's basically trying to split the difference between what Biden has done and what she backed with the Green New Deal in 2020, basically saying, well, I've been able to change my position because we got all this legislation passed under the Biden administration. So now we are supporting green energy. We got all these green energy subsidies in place, so we no longer need a ban on fracking. But she's when you're explaining, you're not winning in politics. So she had to explain herself on that issue. So I think what remains for the next few weeks is, can she now move forward? She needs to get beyond explaining what she stood for in the past and be talking about what she wants to do in the future.
Good points indeed. Yahoo Finance senior columnist Rick Newman. Good to see you.
Hi, guys.
National Security Advisor Jake Sullivan wrapped up his 3-day visit to Beijing this week, culminating in a surprise meeting with Chinese President Xi Jinping. Sullivan telling reporters that he raised concerns about China's focus on economic security and the impact of Chinese business subsidies on the U.S. economy. But with the new administration coming in January, how is China preparing for the next 4 years of U.S.-Chinese relations? For more, we welcome in Shahzad Kazi, China Beige Book International Managing Director. Good to see you. Appreciate you coming on down here. How do you see this going? Let's say, Vice President Harris does become president. I mean, how might her approach to dealing with China differ than President Biden?
Yeah, I think this is the question that's top of mind for the Communist Party right now. Number one, there's going to be much more continuity than not, right? But that's about all we know. There isn't a Harris-China plan as yet. We also aren't really hearing of any heavyweights within the campaign or policy advisory teams that are China experts. So what are we going to get out of them? Right now, not much.
I would love to get your take on this. I had the opportunity to have former Commerce Secretary Wilbur Ross on my Yahoo Finance podcast, Opening Bid, this morning, and I asked him about former President Trump's new tariff proposal. Take a listen to this.
So he's deadly serious about lowering the trade deficit, getting rid of the inequalities, getting rid of the violation of intellectual property rights. Whether that will come out as a big blanket tariff or something else, that's a different story.
Conversely, if Trump wins 4 more years, are we looking at that trade war that maybe didn't really erupt in his first presidency, but could erupt if he wins the White House?
So I think looking at 2025 and onward, there is a round two of a trade war coming between the U.S. and China. If you have a Trump presidency, you're looking at this chaotic avalanche of announcements and policy ideas and actual policies that are going to come down perhaps in a far more aggressive manner than we saw the first time around. But even if you don't get a Trump presidency, what happens is whoever's in the White House, if it's a President Harris, their hand will be forced to get a lot stricter, a lot harder, and a lot tougher on China.
You're out with the latest report as well on the state of China's economy, which showed revenues, profits, hiring, wages as well in August, all slowing from a year ago. What is the latest data showing you?
Yeah, look, the Chinese economy started off on a very strong note, I think, at the beginning of the year. But it was looking pretty clear that from that point onwards, there was going to be some moderation. And in August, you're certainly seeing this mild slowdown. Now, that said, the roof isn't exactly collapsing. And I think the market has been way too pessimistic on China. The data are actually somewhat boring, I'd say. You're still getting a modest recovery through the course of the year. So we're not anywhere near a crisis. But if you're looking for a rally in the equity markets, yeah, you're not going to like the figures that just came out.
One of the most well-known equity market names that's attached to the Chinese economy is Alibaba, quite frankly. And there's been a little bit of an about-face that we've seen between their relationship with government and now making it through this period where they were under high scrutiny. What does that signal to you about how the region is approaching publicly traded entities and just business as a whole?
Yeah, look, I think the idea was we're going to cut Alibaba down to size. That's what she and company wanted to do. And I think they feel like they've done that for now and maybe forever. This does not, I think, spell a change in the overall approach towards business and in the overall approach towards regulation writ large. As the policy environment changes there, I think we could see fresher companies coming under crackdowns. We could see the national security lens that they've taken about every company, every sector. That remains dominant in China. So policy risk is, perhaps receding. It's not going away.
What does that mean for ByteDance then?
Look, ByteDance, they've made it clear. They're not going to let them sell the algorithm. They're going to maintain total control. TikTok is controlled by the Communist Party. That's the fundamental reality.
What does a trade war with China look like? What does that frame that for us?
Yeah, it can take a couple of different shapes. First of all, you've got the tariff war, which is, I think, the most blunt instrument you can use, right? Come up with anything. What is made in China? Put a tariff on it. So it could be sector-wide, industry-wide. It could affect a lot of goods. Then you get to the more sophisticated parts of it, which is where you start getting into things like export controls. You can get even more aggressive and sophisticated and do things like real outbound investment controls, work with Congress on things like raising de minimis rules as they affect packages coming in, Shein and Temu packages that come in today. So it just depends on how sophisticated and how aggressive the person occupying the White House wants to be.
Do you think we get to the point where U.S. companies, I think about a Walmart operating Sam's Clubs in China, I think of Starbucks, that they somehow get kicked out of the country?
Look, anything is possible. Nationalization is even a bigger risk. Those companies have decided that they are in China, for China, forever. And I think the real goal is how do you bifurcate that? How do you let American companies and foreign companies work within China, so long as the Communist Party allows them to, while protecting national interests, core national interests? That's a big debate in D.C., and people are still trying to figure it out.
Shahzad Qazi, who is the China Beige Book International Managing Director. Shahzad, great to have you in studio with us. Thanks. Well, it's time for our chart of the day. Sticking with the presidential race, Brian, you have some interesting stats for us on where predictions market thinks the election might go, might be heading from here.
Yeah, a very simple chart we're going to do in our chart of the day here. And I think it's one chart you need to watch for in September. This particular one comes from the folks over at Goldman Sachs. You can see really the race between the two candidates is very, very tight. So I do wonder, Brad, if we're nearing that point, and maybe September is it, where the market will trade more in line with each party's potential policies, or who is winning or who is ahead in the race.
Yeah, I mean, one of the huge things that I've been tracking coming into this is also just the election watch. And we were able to speak with UBS just recently because it's changed in what we were anticipating coming into this. And there's really four scenarios that we're looking across. It's either a Democratic sweep, a Republican sweep, or you have a Democrat who is the president, and then you have a logjam in government. And then, of course, there's the flip side of that with a Republican president and still logjam with Democrats having Congress. So I think in those scenarios playing out, it really continues to leave a lot of trading desks kind of befuddled as you see the line, and at least the probabilities at this juncture continue to stay this close, at least for those who are continuing to, after the past 2 general elections, trust polls.
Yeah, let's stay on the potential for another Republican in the House, or one that already has been in the White House. I caught up with Commerce Secretary Wilbur Ross. I asked him what another Trump presidency might look like. Here's what he said.
The reason there was so much tumult in the first term was Trump didn't have that many sort of senior level supporters when he ran. Most of Wall Street was opposed to him. Now he's been around a lot longer. He knows how Wall Street works well, but he also has learned how Washington works.
Yeah, and I got to give Wilbur Ross a little bit of a hat tip. I mean, he survived 4 years in that White House. He made it through. I'm not saying it was all, sunshine and roses.
It was a revolving door.
Yeah, and he made it. And now he goes way back with Trump.
He does.
He actually negotiated, I believe, the Taj Mahal bankruptcy. So they go back many decades, but he made it through.
Wasn't he known as the bankruptcy czar or something of that tenor for a while? And let's just bring this back to the consumer as well here, because that's going to be a major economic data point as we continue to move forward. I was actually surprised to see it show up within this University of Michigan survey of consumers this morning that we got out here, and how many consumers are paying close attention to the election. We'd already seen it kind of show up a little bit within some of the Redfin data, the amount of homeowners or potential buyers out there, particularly who are still on the sidelines waiting for and looking at the general election as determinant of what type of home they purchase, where they might purchase, or if they do purchase. And that really comes back to a few other things as well. Beyond sentiment, it's going to come back to the rate environment. Yep. President has no say over that, regardless of how much former President Trump would like to have a say in that. All these things considered, I think it's going to continue to show up in the mindset and data readings like we got from University of Michigan here this morning that gave us a little bit of insight into that.
That's a really good point. I think consumers are just so, first of all, you can't escape any of this coverage, but number two, they just want to hear someone say, hey, I'm going to bring down prices for you. Yeah. And you're going to live a better life. Here's the 5 ways I'm going to do it. And I would say we haven't gone that yet.
Yeah. I would just like to not wake up in a cold sweat watching Twitter every day.
That too.
At this point.
That too.
All your markets action straight ahead. Stay tuned.
Salesforce is back, and they're back with an earnings beat. Let's get right to Salesforce co-founder, chairman, CEO, Marc Benioff. Marc, always great to get some time with you, especially fresh off your earnings call. Love your earnings call. I mean, you always come out blasting on this thing, and you had me thinking about agents, Agentforce. I never heard of this before, didn't know what it was. I think I got it, but let me hear it from your voice. What is this? And set the table a little bit on how it might impact Salesforce's business.
Well, it's a dramatic transformation and opportunity for really all of our customers. And it's very simple, Brian, really. You know, for the last 25 years, what have we been doing? We help our customers build and run their sales forces, their service forces, their marketing forces, their commerce forces, their analytics forces. And now we're going to help them build their agent force. And why this is important for our customers is it's going to give them a level of productivity and automation that they have never had before. And number one, you just look at this great customer we have, Wiley. And all of us know Wiley, the textbook company, they lead their whole industry. This is their moment right now, back to school. And Wiley is selling all these textbooks. And usually what they have to do is surge their customer service organization and their sales organization during back to school, of course. But instead, what they can do is they can scale up using Agentforce. And so, of course, we're already running through all of our apps, all their customer touch points, sales, service, marketing, commerce, everything that they do, it's on Salesforce. And, our data cloud helping to amalgamate their data and federate to other data clouds. But now this third layer that we're unleashing these agents, and these agents can help resolve more than 90% of all of these customer inquiries. That is the exciting moment for Agentforce. And that is the exciting moment for all of our customers.
In its simplest form, Marc, is this AI or robots working with humans to drive better outcomes for businesses?
Well, that's a very good way to say it. This is humans with agents driving customer success. Mm-hmm. It's not so unlike, when I hit the button today to come to the office, I just got in a Waymo, and the Waymo brought me to the office. And that's basically a robot or an agent just driving me autonomously to the office. There was no human involved. This is the extension of our businesses with these agents who can resolve these customer service inquiries for us. We're working with one of the largest healthcare companies in the world who has over 20 million patients and one of the largest Epic databases, all their EMR. And we're already resolving now 90% of all of those patient inquiries with Agentforce. That is very exciting. That is, a huge level of productivity for a healthcare organization. These doctors and nurses are incredibly burnt out post-pandemic. They don't want to have to answer all your basic healthcare questions. And instead, you're going to be able to go right to an agent to get those things resolved. This is a huge advancement in the ability to not only augment their employees, but to deliver that capability and productivity.
Marc, it's been a long day for me, as I'm sure for you, but I want to make sure I heard this right. On the earnings call, you plan to have 1 billion of these agents out by the end of fiscal 2026. I just want to make sure that's correct. And number two, how are you pricing this? Because to me, all this sounds like a higher margin opportunity, but maybe I'm thinking about it wrong.
Well, it's very simple, Brian. The way that we look at it, and we don't have all the answers yet, of course, but we look at one of the customers that's already deployed. OpenTable is using Agentforce, and they have 160 million consumers. They're going to need 160 agents to talk to all of them. Of course, it's really only one agent, of course, but it's manifested 160 million times so that you can make your restaurant reservations or resolve them or reschedule them or, get a make good on a customer service issue, whatever it is. And, that idea that all of those, consumers who work with ADP or all those consumers that work with OpenTable or so many of our customers, it'll rapidly get to 1 billion consumers that we're talking to. And our goal basically is to, monetize it probably by per conversation. So maybe we're, charging those customers $1 or $2 per conversation, something like that. So it's a consumption-based product, and that's an incredible new business model for Salesforce.
Do you think this This should theoretically quiet, and I'm sure you'll talk more about this at Dreamforce in a couple weeks, but this should theoretically quiet what the street has been concerned, not just with Salesforce, a lot of other companies in your space, about monetizing AI. Because when I hear you say $1 per conversation, that's real money, and that adds up very quickly.
I think a lot of our customers have gotten so confused about artificial intelligence. Of course, we have a decade of artificial intelligence innovation at Salesforce. Some of the most important innovations in AI have come out of our labs. But this quarter, we delivered 25 trillion Einstein transactions and powered more than 1 trillion automated workflows and managed 250 petabytes of data for our customers. Now, why this is important, Brian, and where we have to get our head around all of this is that a lot of customers have a false understanding of AI, and they think they're having to build their own models and train their own models and retrain their own models and DIY their AI, do it themselves. And this just is not true. And they can build this model, fine-tune this model, create this model, manage their data, manage their humans, and manage their agents all in one platform, Salesforce. That is what is exciting about the future of the industry and technology. And I think that for a lot of customers, I've seen a lot of science experiments. I think Microsoft has misled so many customers that they have to do so much heavy lifting on the technology side. And we're telling them, you can do this in clicks, not code. You're not going to have to have a hyperscaler to retrain your models. You're going to be able to do all these things right inside our platform. And that is exciting for our customers. They get real value from AI now. And you won't be hearing these stories of these like Microsoft Copilots that don't work, or these, AI hasn't delivered for these customers, or that we spent hundreds of billions of dollars of AI, where's the productivity? You're going to see it coming all right out of this one integrated platform. The apps, or we call Customer 360, the data cloud, the amalgamated data cloud that's federated off through our Zero Copy Alliance to all these other data sources, and then this agent force platform. This is the 1, 2, 3 about the future of automation of our customers at Salesforce.
I mean, do you think, you made that point in the conference call that Microsoft has disappointed so many on AI. I mean, is Copilot and these various chatbots, are they just gimmicky and they're not driving the productivity inside companies that a lot of companies are I guess, trying to pitch to other companies?
Well, number one, I love so many of these models, these consumer models that, I use at home. I'm sure you have the same experience, write me a song, write me a movie script. What about this? It's like a new level of search in many ways. But I also get a lot of hallucinations and inaccuracies. And, we have to deal directly with that in the enterprise. Or when we're dealing with a large healthcare company, we want to have basically zero hallucinations and 100% accuracy. That's our goal. And that's going to require a lot of techniques and technology to kind of deliver that capability to that large healthcare organization. Oh, we are actually doing that now. They do not have the capability, or should they, to build and deliver and create their own AI model to do that. It should all be integrated deeply with their patient information, and to have a whole patient relationship management system and a whole health cloud, if you will. That is our goal. That is what we're delivering for that healthcare organization. Or for a large bank, we're working on one of the largest banks in the world, Royal Bank of Canada, a huge customer of ours already, and to really be able to deliver agent force directly for them and deliver that very high level of accuracy, but also in a highly regulated environment. They have to still comply with all those KYC and government regulations of running a huge bank or financial services organization. We can do all of that inside the platform and deliver that next generation capability of productivity for the bank by delivering the agents and automating the agents, by delivering the data and And yes, humans are not going away. We're going to need to have automation for all of those humans through those applications. And of course, they have thousands of call center workers, they have thousands of salespeople, and actually in that case, tens of thousands. And they're also going to have millions of agents.
And there was Mark Benioff talking all things AI, company's big Dreamforce event happening out in San Francisco in a couple weeks. Lots more, I think, AI announcements you will hear from Mark and the company there. All right, much more markets analysis coming up. You're watching Yahoo Finance's Catalysts. We're taking a closer look at some trending stories on Yahoo Finance. And I want to start by giving a happy birthday shout out to Warren Buffett. He turns 94 today. He's the investing idol for millions of people around the globe and the 10th richest person in the world, according to Bloomberg. And Brad, really, again, happy birthday to Warren Buffett, still leading Berkshire Hathaway. And the company just crossed $1 trillion market cap this week.
It did.
Big week for Buffett.
Yeah. Look, the Oracle of Omaha, as many call him. Many know him for his thesis around moats, making sure that the businesses that you invest in also have some entrenchment as well. And, you know, for a lot of people, that's where some of their early stock market knowledge begins. So Buffett, the stock market slayer.
Yeah, no doubt.
All right, from one admired investor to one who's widely discussed. Elon Musk beat a lawsuit that claimed he amped up the price of the crypto meme coin, Dogecoin, into a pump and dump scheme. Investors who lost money on the token claim Musk purposefully promoted Dogecoin on social media on Saturday Night Live, and by saying Tesla would accept the currency back in 2022, and then Dogecoin lost billions in market cap soon after. And there you're taking a look at the active price of Dogecoin. And if we can throw up a larger chart, I don't know if we do have a larger chart for Dogecoin. Many will remember when it was in conversations of maybe getting up to $1 and what it would look like if it got up to $1. It never sustained a level or got anywhere close to it, really. But ultimately, as you're taking a look over that, thank you so much for that 5-year chart, because that's where I was thinking back to, was early 2021, where this thing got up into the ether of about, and you know, don't even equate this to ether, but using that word loosely, it got up about 50 cents, and then everybody was just like, okay, what if it gets to $1? Yeah, it didn't. And so now we're looking at ultimately some of these lawsuits that came forward here.
I have no Dogecoin analysis on a Friday. I will just say this. I really just love the Dogecoin dog. Did
you see that SNL episode, though, when he talked about Dogecoin?
I didn't see that one. You know, I got to go to bed early, Brad, you know.
You do? You know,
yeah,
but you get up early, too,
That's
on the other
true.
side of that.
All right,
I mean, and they sell belt buckles. Belt buckles that you can buy in Dogecoin.
Maybe I should get one of those.
Tesla
I love that Doge dog. All right, and one thing I don't love. Let's get to this one. Inflation hits the U.S. Open. The price of the tournament's signature cocktail, which I happen to think is overrated, the Honey Deuce, is up for the 6th time since 2012. Back then, it cost $14 for a glass. This year, it's $23. And it's not just the drinks. Tickets are more expensive. They're up 3% from last year, according to sportscasting.com. And there's the Honey Deuce. Those little. I remember those melons. They're melons. They're meant to look like, of course, tennis balls.
Mm-hmm.
I mean, you get to keep the cup. I guess that's okay. But I mean, wow. Can they just let us bring in a high noon, Brad?
You don't want to bring.
I do want a high noon.
It's a classy event that you're going to. You got to represent the U.S. well. It's the U.S. Open tennis tournament.
What if you go somewhere now? It's $46. You want to have 3 of these. You're about like $250 on some rolled out melons, scooped out melons, and some cranberry vodka.
Split one with a friend, and it's $11.50. How about that? That's your inflation hedge. Have more friends.
Wow. Okay.
I mean, here's the other thing. You've seen a lot of other brands that are winning the tournament too right now. I mean, IBM's crushing it this year at the tournament. Just some of the we talk about AI all the time. The likelihood to win that flashes up on the screen, whether you're in the seating or whether you're at home watching. That's been pretty cool. I don't think it predicted that Alcaraz loss, though, that we saw last night. Yeah.
Well, sell rating for the Honey Deuce, at least for me. Coming up is Wealth, our show dedicated to all wealth building needs, all of your wealth building needs, I should say. Brad Smith has you for the next hour. Brad, 3 hours today?
Yeah.
Oh, you're the man, dude.
I try not to think about it.
Stay tuned. Watch Brad.
Long
butt. Who the hell wants long butt?
Yeah.
It's just flat. It's just flat pant. I mean, you spend almost $200 on a pair of pants. I want my cheeks highlighted here. I don't want long butt, Brad.
I don't want to think about.
Is that too
any
much
of
info?
that.
It's Friday.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, positioning your portfolio for a broadening out of the market. We'll talk to a portfolio manager about the best ways you can make this happen. And tax savings tips for every season. We'll talk to a CPA about what you should do in September to potentially save yourself some cash and set yourself up for the next filing season. Plus, all you coupon cutters out there, listen up. We're going to reveal the best day to receive new digital coupon codes in your inbox. Hint, it could be very useful for you to tune in on this particular day. All that much more coming up on today's show. But first, a fresh reading on inflation today is pushing markets higher this morning. On a headline basis, the July Personal Consumption Expenditures Index, or PCE as you know in your hood, came in line with economists' expectations, both on a month-over-month and an annualized basis. On a core basis, stripping out volatile food and energy prices, the monthly reading was as expected, while the annual reading came in just below expectations. And so for more on what this data means for you and your money, we've got Thomas Martin, who's the portfolio manager over at Globalt Investments. Great to have you here with us today. First and foremost, as you looked through all of the readings that we got on the consumer over the course of this week, backward looking as they may be, what is this set up for portfolios out there who are trying to navigate what this economic data means for the Fed's policy pathway?
Yeah, great. Well, thanks for having me on your program. I think the most important thing is that between now and year end, the consumer still seems to be fairly strong. Inflation is under control. And what we're seeing in the marketplace is this question about rotation and leadership and strength. And we're seeing more broad-based strength across the economic sectors, ones that are not just technology and communication services and consumer discretionary, but broadening out into the portfolio. So being more diversified and having more exposure to more names is probably the way to be positioned going into the last quarter of the year.
Thomas, when we think about where investors have switched their focus towards, it seems like we've had a lot of economists, a lot of strategists come on our air and talk about the employment situation and where they're kind of shifting their focus there. What is the core metric, the key data point that investors who are keeping an eye on the employment situation could be and should be monitoring closely as it pertains to what the Fed is going to do on a go-forward basis?
Yeah, we look at claims for the most part, and then, of course, the unemployment number, and then actually the employment number, so how many jobs are being created. And although we got an uptick in the unemployment rate to 4.3%, and we were in the high threes, actually mid threes for a while there, that number seemed to be a bit of an anomaly based on one-off types of items. And so next week, when we get the employment number, we're looking for jobs created to kind of bounce back up into the low 200s area where it had been, it sunk down to 100 plus last time around. And then the unemployment rate to tick back down to 4.2%. That would indicate that the economy is strong. And although employment is weakening, it's not weakening to the point where it's going to hockey stick the way it has in a lot of other past ways to recession.
We've heard a little bit of Fed speak over the course of this week. One of the most notable names, Raphael Bostic, and particularly here as we're kind of squaring away and about to begin September, what is your focus from what you need to hear from the Fed at their next meeting?
Right. So what we expect to hear is that they are going to lower rates by 0.25 percentage point. And then the question is, what is their sort of leaning and how are they going to guide us to think about the path going forward? One of the quotes from one of the governors was that we do a rate cut and then we see what happens. And so that will be more of a data-dependent kind of thing, more like what the ECB did, where they had a rate cut, but they're not sure when the next one is going to be. And that remains a matter of discussion. And not that the U.S. is going to be following the ECB, but that makes sense as you get the cycle started and then you wait and see what happens. And that may be calming to markets unless they have been really expecting this more aggressive rate cutting path, which is what's priced in right now, but it's hard to say how much they're married to that forecast.
Thomas, want to switch gears here just slightly here as rate cutting cycle or rate cut periods in the past have been beneficial to the technology sector. There's been kind of one poster child for technology, and it's Nvidia as of right now. What is your kind of calculus that you're running around Nvidia post earnings, post pullback that we've seen, and now the attempted kind of stabilization for the business going forward? Not for the business, but given the outlook that perhaps isn't as strong as some on the street were hoping for.
Right. Well, it's important to keep in mind that NVIDIA's earnings and sales and margins have been expanding, but by huge amounts. And people look at the return of the stock, up 150%, and say, well, that's a lot. Maybe that's too far, too fast. But given what they've done fundamentally in terms of their revenues and earnings and margins and what they have potentially in front of them, it's really not that unexpected. And the PE multiple at 30 times is, although that's high, and I guess it's subject to risk to the growth rate that they're able to produce going forward, that's not that high compared to some other well-known names, like Amazon or Ecolab, that are also trading at those kinds of multiples. We think that the report was a good report. It beat expectations. It just didn't beat expectations by as much as folks had expected. The underlying fundamentals and Blackwell, which is what really has to work going forward, we're given the indication that that's going to come through. Right. And we got a couple of reports today from Marvell and from Dell that corroborated that, at least, as you said, in the rearview mirror, AI is still driving a lot of revenues and earnings for these companies.
Certainly. Thomas Martin, we got to leave things there on the day. Thomas Martin, Globalt Investments Senior Portfolio Manager. Thanks so much for taking the time here.
Great. Thanks for having me.
Likewise. The beauty industry seems to be the latest hit by slowing consumer spending. Ulta shares one area where that's evident. They're under pressure today after the company missed earnings expectations for the first time in 4 years and lowering its full year guidance. Here with insight on how consumers are spending in the beauty category, we've got RJ Hatavi, who is the head of analytical research at Placer.ai. RJ, good to have you here with us on the program, and thanks so much for hopping on. I mean, look, the lipstick index, as many have been tracking, trying to figure out where little luxuries are holding up. And it seems like there's a little bit of a differing in the stories that we're hearing when you're comparing an Ulta to a Blue Mercury. Just make some sense of it for us, first and foremost.
Yeah, I think what we're seeing more than anything else is that there's a lot of competition in this space. If you look at the beauty category as a whole, it has been one of the top performing categories that we've looked at in terms of foot traffic the last 2 years. Some of that is new store expansion. Some of that is increased visitation at the stores themselves, so comparable transactions or visits. But you put that all together, now we might start to find ourselves in a supply-demand imbalance. Too many stores. Ulta talked about 80% of their stores being affected by a new opening and 50% of their stores being affected by 2 openings. So we find ourselves a lot of beauty stores right now. It's also happening at a time where we're starting to see a little bit of a pullback. I wouldn't say it's overly exaggerated, but we're starting to see a bit of a pullback across a lot of discretionary categories. This really just started to happen in July. A lot of reasons potentially behind that. The cumulative effect of inflation across a number of categories: food, rent, insurance, things like that. So we're starting to see little cracks at the same time. So I think that kind of sets up a situation where maybe tempered expectations in the beauty category going forward here.
Has there been an over-indexing on where consumers are still willing to spend into the beauty category, and which aisles are outperforming from what you've been able to track here?
Yeah, fragrance seems to be the one category that is holding up better than the others. That is the one area we do see a little bit more strength. And if you look and compare that with the manufacturers on that side, it lines up pretty well with that. The other area we're starting to see is actually, we're seeing a little bit of improvement on the lower end of the spectrum. Sally Beauty is actually a name that's pretty interesting right now. It's actually outperformed the rest of the category. They went through a store optimization plan in 2022. If you look at year-over-year visitation trends, it's one of the few that's actually posting visits up right now. So we're seeing a few spots of strength within the category, but overall, it has been one of the better performing categories. But we're starting to see signs of a little bit of weakness as we go in the back half here.
You're also able to, based on Placer.ai data, really look at how much time people are spending in stores. Are there any trends that are sticking out to you on that front?
Yeah, it's a great question. Something we've actually looked at quite a bit is the idea that people, if you look pre versus post pandemic, people are spending a lot less time in stores. A lot of that's because they do their research beforehand. They go into the store, they know what they want. Maybe they're buying online and picking up in stores. So generally, we've seen a downtrend, and the more discretionary the category, the bigger decrease in time. People are still spending some time in grocery, but it's the more discretionary categories that we've seen. The one caveat is that some of the beauty stores that have implemented more services within there, we have seen those hold up relatively well. But generally speaking, we've seen a downtrend in terms of dwell time across the discretionary retail category. Again, it's buy online, pick up in store, and other things that are driving that. But beauty is one of the categories that's holding up a little bit better just because of some of the new service offerings within it.
We spoke to Jose Torres, Interactive Brokers senior economist, earlier this morning about the health of the consumer. I want to play for you what he had to say and then just get your reaction on the other side to round out this conversation.
The consumer has been really bifurcated. You have those consumers that tend to be older, have more exposure to real estate, have more exposure to stocks. They're not doing particularly bad. The market has done terrific. But when you look at the consumer that's really focusing on labor income and is constrained by the pressures of higher prices, tall interest rates, reduced credit availability, and now job uncertainty, I think that's what explains the weakness there.
And are you seeing this same type of bifurcation in consumer spending in beauty?
Yeah, generally speaking, we are. I think the ones that really do cater to a much more affluent audience, so Bluemercury generally has the highest household income of any trade areas that we look at for beauty retailers. Generally speaking, their results are holding up better, whereas kind of the lower, the retailers that cater to the lower middle income audience, those are the ones that are struggling a bit more. And for the very reasons that Jose pointed out, that's exactly what we're seeing there as well. So I think that's pretty spot on. We do see bifurcation in the visitation data across beauty, and not just beauty. We see it across a lot of other categories as well. So I think he's onto something. I think that's pretty spot on.
RJ Hadavi, who is the Placer.ai head of analytical research. Thanks so much for taking the time here with us today, RJ.
Thank you.
Certainly. Coming up, everyone, tax tips for every season. We're going to tell you how to get organized well in advance of 2025's tax day so that you can capitalize on some saving strategies. We've got more just after the break. We are about 227 days away from tax day, April 15th. So you might be wondering, Brad, why are you telling me what I should be doing with my taxes so early? No way am I going to act now. I'm going to procrastinate. Well, if that's your attitude, you may be missing out on some great tax saving strategies. So we're going to be bringing you a seasonal breakdown of what you should do to be maximizing your earnings right here, right now. And here with more, we've got Andrew Gordon, who is the tax attorney, a partner tax attorney and CPA at Gordon Law. Andrew, great to have you here with us. Talk to us about what Americans should be doing right now in September of 2024 to set themselves up for the next tax season.
Thank you, Brad. It's great to be here, and it's great to talk about one of the largest expenses or cash outlays that most people have, and that's taxes. And you're absolutely right. We're in August. Why are we talking about taxes? We've got months before the tax deadline. However, I'll often hear from people in 2025 at the tax deadline wanting to know how to reduce their taxes. And in many situations, it's just too late. Most of the tax opportunities occur throughout the year, the calendar year of your taxes. And so it's important to start considering taxes throughout the year. And most importantly, early on. We'll often also hear from people in December, and then you too have limited opportunities. And so one of the largest opportunities that we should start to be considering today is tax loss harvesting. And I'll talk a little bit more about tax loss harvesting, but that can be used throughout the year. It's not something that by any means you should start to wait until December to start to apply. And so tax loss harvesting refers to selling capital losses or stocks or securities that are currently at a loss position, meaning that you bought it at a price higher than it's trading for today. And although you may say that your portfolio is at a loss, from a tax standpoint, you actually need to sell, exchange, or dispose of those stocks to realize that loss and use it to reduce your taxes.
And so for September, what is the kind of key activity that they need to do to prep for their end of year tax plan?
So throughout each month, it's important to look at your portfolio because as the year goes on, you may lose tax loss harvesting opportunities. As stock prices increase, while it may be good for your portfolio, if you intended to dispose of a stock to take advantage of the tax deduction, you should start to look at it now. Identify what's doing well, what's not, what you want to sell and realize losses on, and start to plan for that. And as the market takes dips, then you could take advantage of those dips, execute on those trades, and realize those capital losses. And those capital losses are incredibly useful. If you've had stock gains or any capital gains throughout the tax year, those capital losses from your tax loss harvesting can reduce or offset those gains. In some cases, even eliminate them in full. And if you haven't used the capital losses in the current year, they can reduce your income up to $3,000 or be carried forward to future years. So even if you don't have gains this year, those losses can offset the gains in future years. So it's important to start looking at your portfolio now and see what opportunities you have. Because December, if the market rallies, prices all go up, and your portfolio doesn't have any losses, it just might be too late.
Right. And so what is the major delta that can take place between September and December that, may be critical for people to plan in September, know where they stand, and then ultimately, once that reconciliation time comes in December, at the end of December and through March and April, that they can kind of get ahead of and know exactly what their standings are?
That's right. Your tax is calculated throughout the year. Although we file our taxes at the year end, what you actually owe is determined based on all of the trades, all of the gains and losses, your income throughout the year. And so we can start to estimate or know what that tax is, or that tax will be come the next year, and start to plan for it, taking advantage of opportunities like tax loss harvesting, also starting to think through whether or not you're going to want to make contributions to retirement accounts, give donations to charities. While you can still do some of these things in December, certainly, there are also life events. There's holiday season. There's all these other things that may occur. And it might just be too late in December to then put money aside for these purposes.
Andrew Gordon, who's a partner and tax attorney and CPA as well, at Gordon Law. Thanks so much for taking the time. Appreciate it.
Thank you.
Coming up, if you're online shopping this weekend, you may want to stick around for our next guest, who's going to reveal to us the best day for new coupon codes. That's just after the break. It's Friday, and we're heading into a long weekend where 3/4 of consumers are either considering or are definitely shopping this year's Labor Day sales. That's according to data from Numerator. But we want to help you get the best deal any day of the week here. So we're looking for some answers in a new survey from Simply Codes. They analyzed more than 30,000 merchant marketing emails to figure out, among other things, the best days to get new coupon codes. So here to tell us some of the key findings, we've got Allison Mack, who is the Vice President of Marketing over at Simply Codes. Allison, great to have you here on the show. So give it to us straight here. What is the best day to get coupons and why?
Okay, so obviously online shopping has become a thing, right? And there's more online shoppers than ever before. It has basically become the normal way of shopping. And actually, we found that this year, there's actually more coupon codes that retailers has released compared to previous years. In 2024, there are 30% more coupon codes that retailers have released compared to 2023. So there's just a ton of promo codes out there. So one of the biggest complaints that a lot of consumers have is, hey, these codes don't work, right? Obviously, coupon codes, there is an expiration date. So we decided to analyze a very large sample of merchants, 30,000 merchants, to see when are they issuing and releasing and dropping the freshest, hottest, newest coupon codes. And we looked specifically at the email channel, and it turns out that it's Fridays is really when the freshest coupon codes are actually dropped, followed by Thursdays and then Wednesdays.
And they're obviously trying to create a sense of urgency around this. Are you seeing a typical kind of time span that people have to redeem those codes that is driving some of that urgency as well?
Yeah, a lot of these codes really does matter. Some of them are only for the weekend and some of them can be for 2 weeks long. So that's the thing, like you really never know when these coupon codes are going to expire. So it is really important to check those emails to see when the freshest ones are going to be dropped.
And so with that in mind, which industry is the biggest culprit of putting out some of these codes?
There are actually 3 categories that we've noticed that are really dropping those codes on Fridays, which is women's clothing, skincare, and the third one is actually adult alcoholic beverage, which makes sense because it is Friday.
Yeah, absolutely. Somebody's going to take advantage of that one. You know, while we have you here, it's so interesting because as we were in our morning meeting, we were discussing how many emails we get and how many of these codes can just fall into promotions type of bucket in your inbox or might even fall into spam, unfortunately, versus people who have a one-on-one and continued relationship digitally with companies because they might have an app that they downloaded. Is there a benefit one way or the other into making sure that you are getting the freshest deals delivered straight to you?
Yeah, absolutely. So if your inbox is like my inbox, it is literally inundated with a ton of emails. And a lot of times I do select all and just clear my entire box. And so a lot of the times you are missing those deals. So if you are into, making sure you are getting the maximum saving, I do recommend having a browser extension or an app very similar to Simply Codes, which is where we curate all of these live, fresh, real-time codes. And it's actually shared by the crowd. People like me and you are testing the codes, sharing the codes, saving the codes, right? And then making sure they are as live and as real-time as possible. And so that is definitely a big recommendation or a big tip that I have for the viewers.
Allison Mack, who is the Vice President of Marketing over at Simply Codes. Great to have you here with us today, Allison. Appreciate it.
Thank you so much, Brad.
Hey everyone, coming up, we've got another episode of Stocks in Translation. Yahoo Finance's Jared Blickry speaks with host of Coinage, Zach Guzman, about Web3 and crypto. That's coming up next.
Welcome to Stocks in Translation. I'm Jared Blickery, your host, Yahoo Finance's data and markets editor, and I am joined by the voice of the people, Sydney Freed. Thanks for tuning in. And before we jump into the conversation, be sure to like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, or wherever you get the podcast. The gentleman sitting across from me is Zach Guzman. You might remember him from such years as 2022 and before. You were an anchor here, and now you are the host and founder of a Web3 media company, Coinage. And we've made a few changes since you got here, but just kind of roll with the punches. On the docket today, we're going to be talking about crypto. Fits in nicely with your career. Our phrase of the day is Web3. Besides being the obvious successor to Web2, what exactly does that mean? And this episode brought to you by the number 3.4 million. That is the estimated worth of Trump's crypto wallet. So let's jump into this and just give me your big picture overview of where we are with crypto, because it's been a wild ride since you left.
It has been. And first of all, thank you for having me back. It's good to be back here. And Sid, good to hang with you today.
Good to have you.
Yeah, I mean, I think we're at a very interesting time in general in crypto. If you think about how far the industry and, the understanding of what it is has come since I left here in 2022, it's night and day. When you have a leading presidential candidate saying he owns it, as you mentioned, and also how big this industry has gotten when you have behemoths like BlackRock also now stepping in. It's wild to come from the FTX collapse to where we are now.
Oh, I know. It's wild to think 10 years ago, I was covering crypto at a Bitcoin conference in San Jose, California. Very different feel. There were literally people with tinfoil hats out there at the time. But we've moved on, and now we want to get to our phrase of the day. That is Web3. And here's the definition. Web3 is the next version of the internet focused on decentralization and user control. It uses blockchain technology to give users more power over their data and online activities. Devil's in the details. So where are we with Web3?
Yeah, I mean, I think, it's kind of a crawl, walk, run approach whenever you're talking about adoption, right? And so right now, the industry will tell you, and main players in the industry will tell you, we're kind of in the dial-up days of the internet in terms of adoption.
I can hear the modem.
Yeah, it goes back to where Yahoo came from, I suppose. But it's like, people need to learn the technology, and Bitcoin's its simplest form in terms of you put money on the blockchain, you can send it, buy it, and basically just do that, buy, sell, trade. But now with Web3, it's what can you do when blockchain technology doesn't just impact finance, but starts to impact, sectors like I'm in, and media revolutionizes this idea of ownership on the internet, where you can't just like things or comment on things, but then actually own pieces of content if it's that. Identity, what does that look like when you put it on a blockchain versus having to trust a government or any sort of intermediary here? And, it's hard to keep hearing we're early. As you and I have covered this for a long time. We've been early for a long time. But, right now we're finally starting to see kind of this adoption cycle really kick into high gear. And I think that's kind of what has people excited right now.
Can you dumb down Web3 for me even further? What are people going to be able to do on Web3 that they're not able to do now?
And maybe what was Web2 and Web1?
What was Web? Yeah, when people say Web, I don't know, my mind just goes. I mean, I get the crypto side of it. I'm just not sure what it means for the rest of the internet.
Yeah, I mean, when you talk about Web3 and why it's, an evolution on Web2, people often talk about read, write, own permission. So if you think about Web1 in the early days of the internet, again, it was mostly not possible for you to do anything on the internet other than just kind of click a link, go and access information. Then you had, in the next iteration of the internet, read, write. And so you could finally
a little interactive.
Yeah, a little bit more. You could kind of write your own blogs. You can do all kinds of things. And then, kind of quasi-Web2 giants came around and made it far easier for people to create content, right? You could now use Facebook to log in, liking and commenting. So you were more in like a robust read, write.
Google Maps got a whole lot better.
Yeah.
Like lots of stuff. Ajax came
Honestly, you might know more than this, because when I Web2, when it was first kind of coming out, I mean,
by age alone, I do know a little bit more. I remember the dial-up all too well.
Yeah.
But take us to the present now. The DeFi movement has kind of taken a step back, I think, at least in the U.S., because there was all kinds of expectations about Gary Gensler coming into the SEC, blockchain professor at MIT, but He hasn't been exactly friendly towards crypto, and it just seems to me like the DeFi dream of being decentralized is just not going to happen in the U.S. Even with these spot crypto ETFs, it's still a long way from pure DeFi.
Well, yeah, I mean, I think that that's kind of the third point to own, right? Read, write, own. Like the last piece of Web3 kind of did get sandbagged a bit when the threat of kind of punishment from the SEC was hanging over everyone's head and everyone in the industry. It became very difficult to deliver on that last piece of read, write, own, which is ownership. And that's kind of what crypto's supposed to all be about. And you kind of mentioned the piece of regulation and now kind of the ETFs it's still quite dependent on centralized powers. And that's not exactly what Web3 is all about.
iShares, Fidelity, and these are brokers, but this is the old school. This is the old school, and they're pretty much here to stay, it seems like. So where do we go from here?
I mean, from here, I think why 2024 is so important is that you do now have a presidential candidate in Donald Trump who has rallied around hating on SEC Chair Gary Gensler. He got a huge round of applause,
standing ovation,
when he basically said he would fire Gary Gensler. So, I mean, that shows kind of where the industry's at with being fed up with the threat of punishing these crypto companies that are honestly just trying to experiment. And we've seen from other people at the SEC, I've interviewed Hester Peirce, not just when I was here, but now over at Coinage to talk about how it's not only Gary Gensler who's steering the ship and how there are a lot of people who want to see experimentation here in the US when you do let individual users try and offer some sense of ownership rather than kind of going through the old tested, tried and true kind of IPO style issuing of things. And so, I think there is an excitement building right now, not just within the industry, but for people who have touched crypto and people who are excited to try, maybe not fully being sold on the idea that everything in crypto is fraud anymore, which is exciting.
And how much does a U.S. president matter to something like crypto? We talk a lot about how, maybe the stock market has tended to do better under Democratic presidents, but overall, we see different things across the board. What about something like crypto? I know Trump has this massive wallet, but does it mean more than that? More than he's a big user?
I think it's very difficult to tell where he sits, not just on crypto, but on most issues. I think that's fair to say. Sometimes he'll change his tune. And with crypto, certainly he has over the last few years, going from calling it a scam
to night and day.
To now selling his own NFTs, by the way, which is also pretty crazy to step back and think about how quickly he's changed his tune. But it does matter. It matters because all of these rules are being written in real time. And you can make the argument, no president really gets to steer Congress's trajectory that much. But when it comes to regulation, a new president does mean a new person at the head of the SEC, potentially.
Yeah, in a relatively new field. I mean, it's easy to say, well, we're talking about these changes that are taking forever to happen. Bitcoin didn't exist in 2008. That white paper was published in 2009. This is a very, very young field. I want to get into some of the technical developments, specifically in Ethereum and some of its competitors. I know with Ethereum, that network, there's a layer 2 deployment. Tell us how that affects the speed and the ability of Ethereum to compete with some of these upstart networks.
Yeah, I think, this is a huge change even for people who have been covering the industry just in the last year. And I think it's, for your guys' viewers, pretty interesting to think about how large of a role Coinbase has played in all of this too, because they've basically rolled out one of the largest and fastest growing Ethereum layer 2. So just to explain kind of what that means.
Yes, please.
Sometimes the layer 1 network, as it's called, Ethereum, is one of those blockchains. Sometimes it can get crowded. Before its upgrades, it got expensive to transact on that blockchain, so a lot of people built so-called layer 2s, which are just networks that are built on top of it to make everything cheaper and quicker. Base is one of those layer 2s rolled out by Coinbase, kind of incubated. And right now, its growth is pretty remarkable, Jared, when it comes to how much it's earning on the fees, because each time someone uses it to transact, Coinbase is racking up now tens of millions of dollars and will be even more as more people use it. And so, when you think about that, it's interesting because it invites, they're cheaper transactions, so it invites all kinds of different use cases because suddenly everything's gotten far cheaper to build on it. But also it changes the dynamics of what Ethereum was all about in terms of now it's kind of earning less itself from network fees, which means Ethereum has gotten slightly more inflationary than it was before.
Interesting.
Which kind of dents the whole use case of why anyone might
Bitcoin
buy
was
it.
supposed to be deflationary. You know, it's built in that you're going to have fewer tokens in X number of years.
Yeah.
How does this, so is there backlash against this? Anytime something goes against, the original intent, you're going to get a little bit of backlash, or is it just working so well that people don't care?
I think it is inviting questions as to what the actual plan here is because, yes, right now you're looking at Ethereum's inflation rate being perhaps the highest that we've seen ever in terms of how the dynamics have changed. So that's kind of interesting to think about when we are now here with Ethereum ETFs. It's a much different story to sell, I think, to investors relative to Bitcoin and being quote-unquote digital gold. And that's simple, and people can wrap their heads around it. When you're talking about Ethereum being a network that now has layer 2s and now everything's being changed, it's not as easy to explain.
No.
And when the numbers start to change, the investment thesis also looks a little bit different when you can't say, hey, it's capped at 21 million as Bitcoin's total supply is. So it changes the dynamics, and I think it also, the market might be underestimating how much it means for Coinbase itself as that kind of, opportunity continues to get bigger and bigger.
We're going to hit on that, but I know we got some basic questions to cover here.
My first,
starting with,
does Ethereum need a kind of like central banker?
Yeah, we heard about inflation here. That's a loaded question.
Yeah, they need to control it. They need to control this inflation.
Yeah, no, it's always interesting to think about how much this industry could be less volatile and more, centered around protecting against some of that. But the whole point of crypto is to not have it. And we saw that can be good sometimes, but also bad in others. Just as recently as the FTX collapse, it would have been nice to have kind of some bank step in and say, no, we're going to backstop all of this problematic selling. So, there are some people who might say yes to that question, Sid, and then there's probably more people, purists, who say, no, that's the whole reason crypto exists, is you can't print more of it and you can't kind of change when things are bad, they're supposed to be bad.
We need to take a short break here, but coming up, we're going to be talking Trump's crypto wallet, plus a battle royale for spot crypto flows. Who carries the ETF torch? Who carries it best? Up next. All right, we are back, and this episode is brought to you by the number 3.4 million. That's the value of Trump's crypto wallet, estimated by Arkham Intelligence. Take it with a grain of salt. They use a lot of assumptions, but we do know from a recent disclosure filing that Trump holds between $1 and $5 million worth of Ether. We also know that Trump made about $7.15 million from NFT licensings. That's separate. How intertwined, and this is something we've been talking about, how intertwined is the crypto market with Trump now, and can the Democrats create some kind of leverage out of this? I don't understand why they're so far behind.
Yeah, this is a massive kind of pain point right now in the industry, Jared. A lot of people are kind of at each other's throats in whether or not, debating whether or not people should throw their support behind one candidate versus another. Because crypto is a technology. Sure. I don't think there's a lot of people that think it should really be politicized, right? I mean, if it can benefit America or Americans, then, we should just kind of say, how do we want to use this technology rather than crypto good or bad? But, anytime you have a president as kind of, I guess, divisive as Trump embraces something, you're going to have other people just instinctively say, I don't like it then. And so right now the industry is a little bit torn on it. I think they're mostly focused on educating Democrats because I think Republicans really rallied around the idea of financial freedom and against big government. And so it's perhaps not surprising that a tool like Bitcoin might connect with them. But now I think there are a lot of people, and I've interviewed congressmen and women who are in the Democratic Party now focused on educating the Kamala Harris camp to say, look, now might be a good time to change your stance. And we are seeing that now. Senator Schumer also came out and said this is something that should be built in the U.S. And so I think we're seeing that underway. And I think the next, days up until the election, anything could happen, but there is a bit of a sea change underway.
Does any of this noise with the politics of crypto affect pricing at all?
I think it has. Yeah. I mean, we've seen it in the last few weeks. I mean,
there's been correlations too. People are looking, Trump's popularity correlated with the price of Bitcoin. I think that kind of fell off. It was correlations come and go. And I've seen studies about the influence of the Fed on crypto prices and whatever Jerome Powell says, but it seems to shift over time. I don't know. What have you noticed?
No, it's impossible to tease this out. I mean, no one knows. You can't in a vacuum say, all right, this is the only thing impacting price. But I do know, in terms of sentiment within the industry for builders, for founders like myself, it's always kind of something you watch is, hey, is this going to get any easier or any harder to build in the U.S.? And on the margin, that does impact kind of how quickly some of these projects roll out. So, I mean, from a numbers basis, I think it does impact things. What would this world look like if you didn't have approvals of Bitcoin ETFs or Ethereum ETFs? And that was a very real thing that potentially could not have happened under Gary Gensler's SEC.
Yeah.
So, I mean, these decisions do matter and they do impact price. I think it's fair to say, almost obvious to say, that we certainly would not be sitting anywhere near 60K for Bitcoin had they not been approved. There are some people who say we'd probably be down closer to 30K, more in that camp. So, I mean...
Yeah, really interesting thought experiment there.
Yeah, it matters.
Is crypto then, because there was a bit where everyone was like, well, it's part of the Trump trade now because he's so gung-ho on it. Do you consider it part of the Trump trade?
If you can even define what the Trump trade is.
Maybe it's the media defining it, but yeah. Would you kind of view it that way?
I would, yeah. I think it's definitely fair to say right now, you heard him and you saw the price moves after the Bitcoin conference in Nashville. He said, I want this to be part of a strategic reserve asset. And it popped. And I think it's fair to say that he does mean that. And there are certainly things that he can do without even Congress, I think, to deliver on some of those things. So yes, I think it's probably fair to say you're looking at a pretty big swing if he is indeed the winner here. But again, there's still time for Kamala Harris to kind of say not so fast. We're not completely throwing our hands up on this technology either. So we'll see.
I want to ask you, you had a front row seat to the FTX collapse. Excuse me. When you're a founder, as you said, you founded Coinage and you actually got funding from the man himself, SBF. What was that like, just kind of watching all of that unfold in real time?
Yeah, so we raised from a few different investors, Alameda Research being one of them, and being the host of a crypto news outlet, I also interviewed Sam ahead of his trial and was there in his house ahead of it. I think it was interesting to have a front row seat to that and other collapses, by the way. We also were the first to interview Do Kwon after his big collapse, that record one. So we've done two now, pretty big kind of interviews with crypto founders that have almost entirely tanked the system. But to have a front row seat to that, I think, again, speaks to how far we've come, right? There were so many people that left this industry for dead when FTX collapsed.
It could have.
Reason, and it totally could have. I mean, I don't think people understand how close it was to kind of wiping out everything. But it wasn't just them. I mean, you had BlockFi, you had Celsius, you had all of these other kind of big centralized lending institutions that also went down. And to see the dominoes fall and to see them fall at Sam's feet and to have interviewed him at his house kind of ahead of that trial and hear him speak. All these interviews, by the way, are still up on Coinage's site at coinage.media.
Yes, check them out.
It's wild to be sitting there and thinking about this man thinks he can get out, and then to see all of it play out at trial.
You were hearing his defenses, like his plan, basically. What were your thoughts?
It was a long shot.
Yeah.
And my thoughts were also, Sam, are you sure that you think that you can do this? And he's like, the judge nailed it, by the way, in terms of his sentencing of 25 years. It was basically, look, you thought about this whole trial as kind of game theory. And he called him out for saying you don't really show any remorse here, but the 25 years is fair because I think you might do this again if you were given the chance, because it's all just a roll of the dice to you. And it was kind of a crazy, attempt to dig into Sam's character, and I thought the judge actually did a pretty good job of doing that.
All right, we want to get to today's Who Wore It Better, and we're going to stick with our crypto theme and talk about ETFs. So right now there are 21 funds in all. These are spot crypto ETFs, with the spot Bitcoin ETFs having launched in January, the spot Ether ETFs in July. BlackRock's iShares, they dominate the totals. Bitcoin ETF, that one is taking in $20 billion in flows this year. Their Ether ETF, nearly $1 billion. The Grayscale ETFs that have been around for years, they kind of throw off the totals because they have higher fees. But taking out those high fee ETFs, we've seen $37 billion go into Bitcoin ETFs, $2 billion into Ether. And again, the Ether has only been around for about a month. So here's where we take a twist. The numbers clearly favor Bitcoin and BlackRock, but what we are asking you, Zach, who's the big winner here? Is it the U.S. investors for finally having access to these products, which were literally a decade in the making? Is it Gary Gensler in the SEC who delayed bringing them to market until the market kinks were worked out? Or do you take the cynical view that it's really the ETF sponsors who are winning here? Who's wearing the crypto ETF hat the best?
It's a lot to digest for you.
Listen, I think, it was well summarized there, Jared, actually, because there are a lot of people who could have easily just gone to Coinbase and bought these things or, spun up a wallet themselves if they really wanted to have exposure to Bitcoin. But a lot of people don't want to do that. They just don't want to deal with any of that. And so finally you have BlackRock's and the like come along. And I would say BlackRock is the big winner here because how quickly they've been able to dominate not just the battle for Bitcoin ETFs, but also Ethereum ETFs here is really showing, I think, their strength. And if you think about how long we have to go, that's huge because the longer this all plays out, the more they are in the driver's seat. And I know there's a lot of people who are like, why the hell are we talking so much about ETFs when this is all built around trying to take on the Wall Street giants? And now here we are. But I think it's meeting people where they want to be. Right?
Yeah.
And the main
set it and forget it. Dollar cost average in your retirement account.
Yeah, exactly.
Buy every 2 weeks until oblivion.
Yeah. I mean, why you got an air fryer when you already got an oven? It's kind of like make it easy for people,
That's my question. Who is buying these ETFs right now?
I mean, there's a lot of kind of like qualitative narratives that it's boomers, right?
Boomer ETFs.
That would be the idea.
I've heard that one quite a bit.
Yeah.
I've also,
I own them. I'm not a.
So you own the new Bitcoin ETFs?
Yeah,
okay.
and you can own just to see, right? Just to see how this is all working and what makes sense here. And there's a lot of people saying too that it also puts pressure on the Coinbases of the world because now people might be able to allocate that.
You've talked about Coinbase a lot here. They just kind of dominate the U.S. market, and you just gave an instance where their product has kind of helped things leapfrog. What's the deal with Coinbase? Are they too big for the U.S. market? I mean, what?
Yeah, it's really interesting to think about Coinbase's role in all this too, right? Because as I said, there is a potential here. I've heard rumors that some people are expecting Coinbase to now put all of the money that they hold for their retail and institutional clients basically on the base Ethereum layer 2. That would be kind of big because essentially they would just be shifting all of this money that exists onto their own existing network. And anytime someone wanted to transact, it would all be there. That'd be cool for people in crypto, I think, because it would be showing kind of like why this matters and why you, again, wouldn't.
But it sounds like purists might be up in arms, I would think.
Well, purists are kind of already up in arms for Coinbase being such a large piece of crypto already, you know? So, I mean, I think they have really shown after the collapse of FTX and Binance that they are the adults in the room. They're clearly right now kind of jockeying for this last remaining piece that has yet to really be defined as, in terms of laws being written around stablecoins. They have a dog in the fight in USDC, one of the larger stablecoins out there. The other one, Tether, is kind of just floating overseas, not really regulated to the same
There's always
extent.
controversy about Tether, but yes.
Yes, and so I don't know. It's very interesting to think about how Coinbase wants to now leverage kind of the existing trust that they've been able to build up with regulators and kind of where that goes. But for your average investor, that might be an even better way to play it than owning these things themselves.
Zach, as we wrap up here, I want to hear the one thing you think people get wrong about crypto. 30 seconds or less.
I think everyone gets wrong that it's scams and frauds. I think we've seen that play out for a long time, and that can't be true and have BlackRock welcome in this technology with open arms and potentially, maybe a few presidential candidates. And so I think that that's definitely one thing that people get wrong. I think the other thing is it's not as complicated as everybody makes it out to be.
Anymore.
Right now, things have gotten way easier. And so, you don't need to be a computer whiz or a guru or even developer to kind of understand why this stuff matters. And I think the biggest mistake is people always think that this only matters for finance. I think increasingly, as all of the other complications get abstracted away, this is going to matter for every other industry out there.
We're going to leave it there, Zach. Really appreciate you stopping by. Sydney, as always, thank you. And we're going to say goodbye, but first we want to make sure you check out other episodes of Stocks in Translation on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, YouTube, Apple, Spotify, iHeart, Podtail, Pod Paradise, and more. Keep your dial locked to Yahoo Finance.
And that's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. And stay tuned for Market Domination with Josh Lipton and Madison Mills. That's coming up at 3 p.m. Eastern Time. You don't want to miss it.